See, in the last class, we discussed and solved an illustration on section 40 class B. Partnership firm assessed as such case. So for that, two conditions should be satisfied. There should be a deed among the partners and there should be PSR, profit sharing ratio. In these two cases, you can consider it being firm and assessed as such. Assessed as such. So in this case, you have to find out the book profit. Book profit is nothing but net profit what you calculate. Net profit what you calculate as per the financial report and do plus or minus with respect to the provisions under Income Tax Act from section 30 onwards. Some may be deductible, some may not be deductible. All these things are adjusted to arrive the PGBP value. Here, interest on capital for the partners as well as the loan can be deductible. Maximum 12% is allowed. That too, it should be given in the deed. It should be given in the deed. If it is not mentioned in the deed, it cannot be deductible. It cannot be deductible. Is that clear? And if you have already subtracted the salary of the partners, salary, commission, remuneration, but whatever name may be, for partners, that should not be deducted. Add it back. So after adding that, what the value you get is called book profit. Is called book profit. From the book profit, you can calculate the remuneration, which is up to 6 lakhs, whichever is higher of 3 lakhs or 90% of profit, book profit. Above 6 lakhs, 60% will be addable. 60% will be addable. Okay. These two will be as per section 40 class B. And not only that, it should be in the deed. Okay. Limit. Or actual payment. Between these two, whichever is lower will be offered under section 40 class B. Clear? So this is a simple format like you can keep in your mind. Net profit plus or minus the provisions we have applied under sections 30 onwards, 30, 31, 32 and all. Based on that, some may be deductible, some may not be deductible. So we do all the adjustments and arrive the PGBP. From that, interest on capital and loan to the extent of 12% maximum, but only 10% is allowed, then you can take that 10%. If it is beyond 10% and balance will be disallowed. Salary to partner is first added back, should be disallowed because we are going to calculate the salary to the partner separately later on. So salary for the partners can be calculated based on the actual amount payable as a salary and statutory limit being this one. Between these two, whichever is lower can be deductible as salary to the partners. Okay. Now, here is the format, book profit. PGBP as per section 28 to 44D, but before remuneration. So once you calculate the book profit, PGBP after all adjustments falling under this section. Remuneration to the partners, if it is already debited, should be added back to get the PGBP. And two more adjustment will be carried over, one more adjustment. I will explain that later. After that, you will get book profit. In that book profit, salary will be payable up to 6 lakhs. Up to 6 lakhs. Whichever is higher of either 3 lakhs or 90% of the book profit. If the book profit is more than 6 lakhs, 60% on such extra book profit will be added. This will be the total profit. Will be compared with the actual and this one, whichever is lower, will be taken. In case of interest on drawings, credited in P&L account is correct, requires no other further adjustment. It's not required to be adjusted in the interest on capital. These are the cases you have to understand. Now we'll start with this illustration. X&N company partnership firm as such furnishes the following profits and loss account for the previous year ending 31st March 2025. Profit and loss, and we have net loss. You start with the net loss, profit or loss as per books. As per books. The value being 1,72,000. Now, the other expenses debited include 13,600 not allowable under section 37 class 1. The expenses can be debited only in the P&L account only if it is being revenue nature as well as business related. May not be fine related to the legal violation or some other reason also. In those cases, you can debit. If it is not satisfied, then it cannot be debited. So, as such, this 13,600 cannot be debited. If you subtract 13,600 from here, debit side expenses is reducing and it will increase the profit. But in case of loss, it will be decreasing. Okay. So, you add disallowed expenses. Disallowed expenses under section 37 class 1. The value being 13,600. I keep that net profit and loss in negative and this is positive number. So, from the negative you have to add this one. Interest to partners is in excess of 7,100 not statutorily allowable. Interest on partners where 7,100 should not be. Okay, maybe excess than 12%. So, that will be removed. If you remove, profit will increase. So, it's an addable item. Disallowed interest on capital under section 40 class B. This value being 7,100. This value being 7,100. Apart from that, cost of goods okay, sales okay. This is also taken. I taken net loss taken. Remuneration to partners is going to be calculated. Whatever the remuneration to the partner already debited should be removed. If I remove this, automatically profit will increase. So debit item. Sorry, my addition item. So remuneration to partners. Remuneration to partners. To partners. The value being 68,000 should be addable. You are required to compute for the assessment year 25-26 book profits of the firm. The value what you get here is called book profit. Come on, how much is that? 80? 300. Minus or positive? Minus. Second one is remuneration is permissible to partners. You have to calculate. So minus remuneration. Under section 40 class B. Whichever is lower of number 1 actual being 68,000. Number 2 limit. What's the limit? Up to 6 lakhs of book profit, 90% or 3 lakhs. Whichever is higher will be taken. So this is negative and 3 lakhs is there. Whichever is higher, 3 lakhs can be taken. 3 lakhs can be taken. As the profit being negative, you have to take 3 lakhs directly. Between these two, whichever is lower, 68,000 can be subtracted. Now, income of the firm. So PGBP for the firm being of this 1,51,300 negative. 1,51,300 already negative. By subtracting this one, automatically the loss is increasing to 1,51,300. Now, understand one more thing. What about the tax applicability? For this, tax is applicable anyhow. As negative, you can carry forward this for the future period. Right. To the extent already claimed as deduction on receipt by the owners or partners will be taxable. In the hands of the owner, this 68,000 deducted, no, already taxable on receipt basis, and interest to this extent 25,000 minus 7,100. How much is that? 17,900. 17,900 is taxable in the hands of the recipient, and 68,000 is taxable in the hands of the recipient. But shared profit will not be taxable because this profit is taxed already. These two were considered as expenses deducted, means tax on these two not paid. As these two are not taxed, it may be taxable in the hands of the recipient. As this was already taxed, on receipt of this shared profit and loss will not be taxable at all. Is that clear? Now, as per section 10 clause 2a, share of the income from firm is exempted. Any profit share you receive from the partnership firm is exempted because already it was taxed there. In case of loss of firm, cannot be shared. Loss cannot be shared but can be carried forward for the firm itself in the future to be adjusted. Clear? Hope now you will be able to understand this concept. Okay. So let me give the summary here. What the partners will get from the firm? Firm to partners. Number one, PGVP. Okay. Taxed in the hands of whom? Firm. Okay. What about partners? Okay. Will be exempted. Exempt in the hands of the partners on receipt. Second, interest on capital. Interest on capital. In case of interest on capital, number one, up to 12%, up to 12% on the capital, claimed deductible expenses in the partnership firm's profit and loss. As it was deducted there, it is not taxed there. As it is shown as an expenses and it reduces the profit, so as it is already deducted from the firm, it is not going to be taxable. It is not going to be taxable. As it is not taxable in the hands of the firm, automatically it is taxed in the hands of partners. Okay, for firm it is deductible. Second, above 12%, disallowed. Disallowed means not deducted. It will raise the taxable income and firm will pay the tax on this. And here partner will not pay tax. Here partner will not pay tax. And third scenario, salary. As per section 40 clause B. As per section 40 clause B. Deducted in the firm are not taxed in the firm but taxable in the hands of the partners. Okay. Okay, here it is exempted and here taxable. I'll write this way. Okay. What happens to firm? What happens to partner? Maybe more clear. In case of PGBP, taxed and exempt under section 10 class 2A. Interest up to 12% deducted in firm but taxable in the hands of the partner. Above 12% not deductible. Okay, not deductible means disallowed. Then it is not considered in firm but it is going to be taxable in the hands of the partner. Salary to the extent of section 40 class B, deductible in firm means not taxable but taxable on receipt basis. Taxable on receipt basis. These three are going to be taxable in the hands of the partner. Clear? Once again. This one is disallowed, but it is not considered here, exempted. Okay. About 12% is already debited there, disallowed there. So as it is disallowed there in the partnership firm, may be taxed in the firm itself. So not required to be deductible, taxable in the hands of the partner. Clear? Now, let's see here. ABC are partners in ABC and Co, which has sustained a loss of Rs 2 lakhs during the previous year. Remuneration paid to A, B, and C 1 lakh. Okay. Now, what about the salary? Section 40 class B. For the salary calculation, whichever is higher of actual being 1.5 lakhs, 2 lakhs and 1 lakh, 4.5 lakhs. Second one being actual and second one being limit. As the value is a loss, the limit being 3 lakhs. So 1,50,000 will be, so 3 lakhs can be subtracted. We assume this will be the book profit 2 lakhs. Salary is subtracted from here 3 lakhs. Ultimate profit being 5 lakhs. Clear? So what happens here? Firm, salary, PGBP shared, salary also given. PGBP will be taxable in the hands of whom? Firm. And in the hands of the partners? In the hands of the partners, A, B, C. Exempt. Is that okay? Salary being deductible and it is going to be taxable in the hands of A, B, C. A, B, C. Now, in PGBP, 5 lakhs will be the loss. Loss cannot be, of course, clubbed with the partner's hand independently. it can be carried forward to be adjusted in the future period. You can carry forward and adjust in the future profits over 5 years period, over say 8 years period. Clear? Now in salary, only to the extent allowed under section 40B will be taken. This amount is deductible from the firm's profit, so we have already deducted. After deducting the salary to the firm, the loss for the firm being 5 lakhs, and amount deducted will be taxable in the hands of the partners. While it is taxable in the partners, in whose hand it is going to be taxable? A, B, or C. So now their remuneration ratio being 1.5 lakhs, 2 lakhs, and 1 lakh. Otherwise, 3 is to 4 is to 2 is the ratio. Is that okay? This entire 3 lakhs will be taxable in the hands of partners in their own actual salary receipt basis. 3 is to 4 is to 2. So 3 lakhs, 3 is to 4 is to 2 ratio. If you segregate in that ratio, A has to pay tax on this 1 lakh and B has to pay tax on 1,33,333 and C has to pay tax on 66,667. Clear? Clear? Shall I move on to the next one? Make it faster. Now, I don't get any response from online. Come on, online students, come on, make it faster. Three is to 4 is to 2 is nothing but their original salary ratio. 1 lakh 50, 2 lakhs and 1 lakh. 1 lakh 50, 2 lakhs and 1 lakh. Otherwise, 3 is to 4 is to 2. Clear? Now, Uttar and Dakshin are partners of PP traders. Furnishes the following details. Always start with the net profit given in the books and do plus or minus as per the provisions under sections 30 onwards. So net profit as per the books. As per books. 87,500. 87,500. Clear? Additional information. Depreciation for the year allowed under section 32 is 30,000 rupees. But depreciation debited in P&L account being 40. This is disallowed. Only this is deductible. The disallowed will be added. Depreciation as per the books is added. That should not be deducted, right? As per books. And what depreciation can be subtracted? You can subtract depreciation as per section 32. 30,000 can be subtracted. This should be added, this should be subtracted. Clear? During the last year, the firms had incurred loss 8 lakhs 50, which includes unabsorbed depreciation 50. I have to calculate this separately. At the last, I will explain this. Interest on loan taken from bank is yet to be paid. So, interest on loan from bank remains outstanding. If this is being outstanding, disallowed, because interest on loan borrowed from scheduled bank, financial institution, NBFC will be deductible only on payment basis, as this being outstanding cannot be deductible. This 45,000 cannot be deductible. Okay. So if you are not deducting, that profit will increase. So interest on loan. Interest on loan. Disallow. Disallow. Under section 43B. Quoting the section is not required, but anyhow, while studying, you just try to remember those sections, so it will give more confidence. 45,000 rupees. Okay, second point to be adjusted. Okay, in the profit and loss, gross profit, okay. Interest on drawings, if it is given, no need to adjust this. In the debit side, bonus paid to employees. Bonus can be deductible on payment basis. Nothing stated. We assume this bonus was already paid. So 43, section 43B is satisfied. Other expenses, nothing stated. Salary to partners, first of all, you have to remove, because we have to calculate the salary to the partners as per section 40 class B proviso. So add salary to partners. Salary to partners. Salary to partners, disallow. This value being, come on, how much is that? Add up these two, get me the value. 7 lakhs. Make it faster, make it faster. 7 lakhs 32,000. Interest on capital allowed 15%. But actually, section 40 class B says only 12% is disallowed. Sorry, allowed. So beyond that is disallowed. 3% excess than the amount allowed. So 3 by 15 is disallowed. Come on, tell me, how much is that? Add that interest on capital. 2,100. Depreciation also adjusted. Come on, find out the profit here. $8,76,600 minus usually this is a book profit. Because of the adjustment number 2, I am going to do one more adjustment here. What's that? Whichever is lower of, one is unabsorbed depreciation, or PGBP. What you calculate here, this is the PGBP calculated here for the taxability, minus brought forward business loss. Okay, unabsorbed depreciation being 50,000 rupees, and for that the PGBP being 8,76,600 minus brought forward business loss being 8.5 lakhs. From that 50 is subtracted, so 8 lakhs is the brought forward business loss. From the previous year, we brought forward around 8.5 lakhs. Out of 8.5 lakhs, 50,000 related to the unabsorbed depreciation, balance will be the regular business loss. So from this 8,76,600, you have to subtract this 8 lakhs. Then ultimate value here being 76,600. Between these two, whichever is lower can be deductible. This value is called book profit. Clear? Now, in this book profit, how much is it? 8,26,600. You have to calculate the salary under section 40 class B. Whichever is lower of actual and limit. Actual being 7,32,000 rupees. 7,32,000 rupees. Limit 8,26,600 up to 6 lakhs. 90% will be taken. Beyond that, 2 lakhs 26,600. On that, 60% will be taken. Come on, get me the value. 6 lakhs 75. You have to add these two. 75,960. Then here 6 lakhs 75,960. Is that clear? So we got the salary. Now, what happens here? You have to find out the profit or loss for the partnership firm. Okay. PGBP before remuneration 8,76,600. From that you can subtract what? Remuneration calculated under section 40 class B 6,75,960. The value will be net of profit, net profit PGBP for the taxable income. How much is that? 2 lakhs 640. 2 lakhs 640. Clear? 2 lakhs 640 will be the profit. And from that profit, you can set off and adjust the brought forward business loss. So we have two losses. 8.5 lakhs in that 50,000 related to unabsorbed depreciation. Balance 8 lakhs related to business loss. You have studied under section 32 class 2. Am I right? In section 32 class 2, how can we adjust the brought forward business losses and unabsorbed depreciation? First, you have to adjust the current year depreciation was already adjusted. This is the current year depreciation. Second, adjust the business loss. Third, adjust the depreciation. In this year, we have this much profit. This 8 lakhs can be adjusted here. So, set off brought forward business loss. 2 lakhs 640 can be set off. So, out of this 8 lakhs, you can set off balance. Still, how much we have? 7 lakhs? 5 lakhs 99,360 still you have. It can be carried forward further. It can be carried forward further. This can be also carried forward further. Clear? So now currently the taxable income being 0. Taxable income being 0. What about the P&L ratio of these two partners? Nothing stated. So we assume it may be equal partners. Now, from the firm to partners. Okay, what are the items transferred? One is interest on capital. Interest on capital. Okay, interest on capital. How much is that? Okay, for Uttar 4,500, for Dakshin 6,000. Apart from that, salary payable to the partner being Uttar 2,44,000, Dakshin 4,88,000, the actual payment. Clear? Apart from that, Profit share is also being payable. What's the profit share? 87,500. That's whatever the ultimate profit. Okay, whatever it may be. 87,500 is shared between these two. Okay, Uttar and Dakshin. Okay, or balance profit. Balance profit. Whatever the balance profit may be. How can I calculate this one, sir? Very simple. Total the payable to the partners and then you can calculate. Okay. So the profit as per the books, all these things are as per the books. As per the books, the profit being 87,500. 87,500. Shared between these two equally. Come on. How much is that? 43, 750, am I right? 43, 750. 43, 750. Okay, these are the payments done by firm to partners as per the books. Now, what about the taxability? In case of firm, of course, this is taxable. But currently, as per the taxation calculation, the taxable profit being zero, you don't need to pay any tax here. Taxable, but the tax is zero. In case of interest on capital, deductible to what extent? 12%. 12% is deductible. Balance will be taxable. To that extent of deductible will be taxable in the hands of the partners. Okay, this is being 15%. This is being 15%. And deductible to the extent of how much? 12%. That is going to be taxable in partner's hand. Okay, those extent not deductible will be taxable in the firm itself. Okay, non-deductible extent, how much is that? 3 by 15, 1/5, 900 rupees. 3,600 will be taxable in the hands of partner. And not deductible extent in this case being 1,200 to the extent of 12%, 4,800 is taxable in the hands of the partner. Salary 244, 2,44,000 given. Though 2,44,000 given as per the books, originally allowed being only 6,75,960. To the extent allowed is going to be taxable in the hands of the partner. Okay, to the extent not deductible is also calculated separately. To the extent deductible will be subtracted here. Come on, tell me. This 6,75,960 will be shared in their own this ratio. Existing salary ratio 244,000 is to 488. Otherwise 1:2 ratio. Share this in the 1:2 ratio. To the extent deducted in firm will be taxable in the hands of the recipient. How much is that? 3 lakhs 37,980 is taxable here. 3 lakhs 37,980 taxable here. To the extent not deductible will be the difference between these two. That you cannot show that separately. You have to show that collectively. It is not for U and D separately. Collectively you can show. 7,32,000 actually deducted but disallowed. Only this much is deductible. So the difference between these two is disallowed. The extent of disallowed is not debited in the firm is exempted in the hands of the partners. Exempted in the hands of the partners. How much is that? 56,040. These two were already taxable in the hands of the firm, so totally exempt in the hands of the partners. Clear? Totally exempt in the hands of the partners. Clear? So if it is not taxable and deductible in firm's angle, then it will be taxable in the hands of the partners on receipt. Okay. Now, here you'll see from the PGBP, you can subtract whichever is lower of unabsorbed depreciation. Another one is PGBP minus brought forward business loss alone. Between these two, whichever is lower is deductible to arrive the book profit for the calculation of salary purpose. Salary will be calculated on this. Later on, from this, that salary is subtracted to find out the taxable income for the business. For the salary calculations only, this profit is matter, not this profit. Originally, this is the profit for the firm. This is the profit for the firm. Is that clear? So, here this value I calculated, this is for calculation of salary only. PGBP income is this one only before salary. So from that you subtracted the salary and other thing. Should not subtract from this one. Should not subtract from this one. You have to subtract only from this. Okay, here actually you are deducting the depreciation first of all. Actual provisions under section 32, you have to deduct the business loss first of all. Thereafter, if you have surplus, then you can adjust the depreciation. That's the order, right? So these are the points you have to note. Now, here, interest, simple interest up to 12% is allowable. Am I right? Provided if partner lends the amount to firm. Okay, lending, and interest is payable, then the interest will be deductible up to 12% of the capital. Clear? Firm, partner, partner's family. Partner's family gave the money to partner. Partner gives the money to firm, stating that I am not actually giving out of my money, I am giving it from my family. Then the firm gives the interest to the partner, maybe say 20%. How much is allowed, sir? Actual will be allowed because this is not the borrowings from the partner, it's borrowing from partner's family. He is only a representative. Partner not being the owner for the amount he is given. So here he has given. Clear? That's the main thing you have to understand. To make you understand, here is the concept. Okay, partner's capacity. This one let me explain. Partnership firm and A. Okay, A. Okay, A being the individual. Now Huff, Hindu undivided family. Hindu undivided family gave the loan. That loan is given to the firm and the firm gives the interest and that interest is transferred here. Now A being after all representative for the fund given to the firm, not being the owner for the fund. So here what about the limit? Not applicable. A gives the loan out of his own savings and interest is given. Then limit is applicable 12%. Limit is applicable 12%. And firm. In a firm, Hindu undivided family being the partner. Okay, here I am talking about partner. Okay, fund by. So Hindu undivided family. Who is the partner in the partnership firm? Hindu undivided family. And Hindu undivided family where Mr. A being the member. Member gives the fund to Hindu undivided family. One of the members of the Huff. Huff gives the loan to the firm out of that fund. Interest is transferred from firm to Huff and later on it is ultimately transferable to A. So actually partner being Huff but fund received from the member will not be considered as partner's loan. So limit is not applicable. Hindu undivided family has deposits and from the deposits loan is given, interest is paid. Okay, then what happens here? Limit 12% will be applicable. Limit 12% will be applicable. So partner capacity individual, probably first scenario. Loan capacity, he gets a loan from Huff, funded by Huff. Then not applicable is the answer. Next one is partner's capacity being individual, maybe A. Loan out of his own fund, funded by he himself. So partner capacity being individual, he himself funds the for partnership companies, partnership firms requirement. Then limit 12% is applicable. In case representative of Huff, here rather than Huff, okay, rather than Huff, signed by A, though signed by A, but he is not depositing his own fund, he may be acting as a representative person for the Huff, representative person of the Huff. Is that okay? Similarly, sign. How can you sign? Right. In a partnership firm, if you are being the partner, you need to enter into agreement. And in agreement, you have to sign, right? In partnership firm, in Huff, we may have around 10 family members also. How we can allow all the 10 members to sign? Then we asked Mr. A to sign, but as representative capacity here. Means he gets the fund from the Huff and he deposits. Only signing is in his own head, in his own hand. So though A being the partner, but A being the representative of Huff, means only Huff is the partner, A is the representative person for signing purpose. If the loan is given by A, means third party is giving, like member is giving, and partnership firm funded by the Hindu undivided family, but signed by A, signed by A. But now the loan is given directly by A, then the limit is not applicable. Last scenario, representative being the Huff, okay, A himself representing the Huff, representing the Huff, and fund is also given by Hindu undivided family itself, then 12%. So with that, section 40 class B is over. Let's move on to the next one. Section 40A, class 2. Here we are going to study around 5 sections. Okay. Now, A and Co, where A being the trader. A being the trader in his trading and P&L account. He purchases goods for rupees. Okay, he purchases the goods for rupees 100 and sells it for 200. That's the usual one. Suppose A's brother supplies the goods. A's brother. And to whom A and Co makes a payment of 150 and sells it to outsider at 200 only. So what happens here? 100 rupees he purchased from unrelated party and sold for 200. From the related party, A's brother being the relative, from whom he purchased for 150, sold for 200. So A and Co disclosed their profit as 250 being the expenses, 400 being the income. On tallying that, so their profit being 150. That's how they reported their profit. They reported the profit. And now section 40A says, section 40A class 2 says, as the commodity is purchased for 100 and sold for 200, if you are purchasing from unrelated party, why do you pay 150 rupees and sell it for 200 rupees, making only 50 rupees profit? Naturally, you are able to pay around 100 rupees profit, right? So buy at 100 and sell at 100, 200 rupees, you can make 100 rupees profit. But why do you pay 150 to your brother? Maybe to help your brother, right? There's an intention to help your brother, or you are transferring the profit earned by you to some third party, like it's actually cheating, like, okay. So immediately government comes with a provision that the excess amount you paid, 50 rupees, that will be now addable. So net profit as per the books being, 150, add excess payment to brother. Excess payment to brother, reasonably not so. It's unreasonable. Okay, that excess payment seems to be unreasonable, is disqualified. So only 100 is eligible, but you are paying 150 to support your brother. By paying more money to your brother is now happy. His profit will be increasing, but it's a cheating like. So automatically what happens, an excess payment 50 rupees will be considered as your income. Automatically 200 will be your taxable income in this case. What about your brother case, sir? Usually they purchase it for 80 and sells it to 100, and your brother purchased for 80 and sells it for 150. Okay, if it is being the unrelated party, buys for 80 and sells for 120 rupees is profit. Am I right? And brother buys it for 80 and sells for 150. What is his profit? 70 rupees is his profit. Right. But though the profit is 70, actually income tax department allows only 100 rupees, another 50 disallowed. Can I consider the only allowed item being the sale for A's brother? 80 minus 120, can I take it 20 like? No, sir. This provision is applicable for the excess payment, not for the excess receipt. For A's brother, it is the excess receipt. Usually he can sell it for 100 rupees, but because of the brother, he sells it for 150. Okay, means the support is given by the big brother, like, okay, that happens here. And that will not be adjusted in the hands of A's brother. He has to pay the tax for what? 70 only. But for A and Co, no, they have to pay the tax on 200 rupees by adding the excess payment. Clear? Section 40A clause 2 says unreasonable payment to specified person. Who is called a specified person? So relatives in case of individual. In case of company and partnership firm, how this will be happening? Let's see here. In case of individual, spouse, parents, brothers, sisters, lineal ascendant and descendant. Okay, their parents and all. Father, grandfather, and son, grandson, all will come under lineal ascendant and descendant. Okay. So the lineal ascendant and descendant, spouse, parents, brother, sister, all will be considered as relative. If you are buying anything, or if you are getting any service from these parties, or if you are getting any rental premises or interest payment, whatever it may be, it seems to be unreasonable. To the extent of unreasonable, cannot be debited, should increase the profit and you have to pay the tax. But for the recipient, it will not be a matter. Actual receipt will be taken there, right? In case of company, probably XYZ company and limited company. Okay. Now, where director will be relative, specified person, and their relatives also, who are called relatives, spouse, parents, brother, sister, lineal ascendant, descendant. These two are specified persons transaction. Automatically, unreasonable extent disallowed. Another one is Mr. X. Mr. X. Okay. Keeps around 20% and more. 20% or more share capital. More share capital. Then these two are called what? Specified persons. And of course, if any payment made to Mr. X seems to be unreasonable, is disqualified to be debited in the P&L account. In case of individual, relatives. Relatives means spouse, brothers, sisters, and lineal ascendant and descendant will be taken. Instead of XYZ limited company, if it is being XYZ and Co, partnership firm. Here, not only Mr. X, okay, along with his family members also holding, okay, relatives. Not only Mr. X, and the holding is done by relatives also. Is that okay? Then Mr. X being the specified person here. Mr. X keeps around 5%. Their relative keeps around 21%. 16%. If you add up these two, it comes around 21%. Then automatically Mr. X being the related person. Okay. Instead of being this company, it may be partnership firm. What happens here? Mr. X being one of the partners, his PSR, profit sharing ratio, PSR being 20% and more. Okay, 20% or more. Okay, or more. Is it held by Mr. X only? No, sir. Mr. X and relative. And relative. Clear? In this case, these two are called specified persons. These two are called specified persons. Okay, this is called substantial interest. This 20% case, will be named as substantial interest. Third point. In case of company, directors and their relatives, apart from that, any person with his relative having substantial interest, that is 20% or more shares. In case of firm, AOP, BOI, partners are members. Usually we call the term partners in case of firm, but other cases it will be members and their relatives. Any person with his relatives having substantial interest. That is 20% or more in PSR. Here it's a share, here it's a PSR. In case of Hindu undivided family, all the members and their relatives. All the members and their relatives. Fifth one being subsidiary company of common holding. H company keeps more than 50% share in A as well as B. Okay. Here also 50 plus percentage shares held. Here also 50% plus share held. So H being holding, A and B are the subsidiary for H. And here A and B will also be considered as specified persons. Okay. Subsidiary companies where common holding. So H company being the common holding for these two. If any purchase is made by A from B and for that the payment is unreasonable, then it will not be deductible under section 40A class 2. So individual case, company case, firm case and Huff and holding and subsidiary cases. In these cases, if you are finding that person being your specified person, the payment seems to be unreasonable, that unreasonable extent will be disallowed. Clear? Come on, make a note of it. Now, section 40A class 3. Section 40A class 3. Already we studied under section 43 class 43 class 1 actual cost calculation. If you are making payment in the form of cash, automatically in excess of 10,000 will not be considered as capitalization. Whatever the expenses you do, if the expenses being more than 10,000 rupees, that may be in the form of cash is disallowed to be debited in the P&L account. Non-cash model. Demonetization, right? Don't involve transaction in cash form. Is that clear? Section 40A clause 3. And it's not cash, or it is not in account paycheck. What more? Payment is allowed if the payment is made in account paycheck or DD or any electronic clearing system, ECS, like BIM, UPI, and NEFT, RTGS, whatever it may be, everything is accepted. What is not accepted? Cash form is not accepted. Even checks are, in case of check, crossed check and bearer check not allowed. Cross check and bearer check not allowed. But in case of section 36, class 1, subclass 1B, we have already studied that, right? Insurance claim for the insurance premium for health of employees, where the payment should not be in the form of cash, maybe in the form of check, even though it may be bearer check is allowed there. Okay, you have to understand the difference between that one and this one. Here, okay. Through check, not in the form of cash. The check could be account pay check or bearer check. Bearer check means even cross check also okay. But here it's very specific. It should not be cross check or bearer check. It should be account pay check only. Clear? Only these are allowed. Only these are allowed. So account pay check, DD, ECS allowed. Cross check, bearer check, cash not allowed. Allowed and disallowed. So we have completed the provisions. Some exceptions are there given under rule number 6DD. Once it was asked about exceptions to pay in cash beyond 10,000 also qualified to be deductible. List out around 4 or 5 items. So you no need to remember all these things, at least 4 or 5 items you have to remember. Anyhow, I given around 12 items, like I grouped that to easily memorize all these things, group wise group. Okay, one is payment to banks, like if you are depositing the amount in the bank, of course you have to deposit only in the form cash, right? So that to any payment made to RBI, banks, cooperative bank, LIC, credit society, government. In these cases, payment can be in the form of cash beyond 10,000 also qualified to be deductible. And even the payment by way of LOC, PT, BOE, bill of exchange, NEFT, credit card, debit card, book adjustments allowed. Letter of credit. I am giving the letter for supplying the goods in credit is called letter of credit. So the letter of credit may be not treated as a cash transaction, so it will be allowed. Telegraphic transfer also allowed. Bill of exchange. Bill of you are giving the payment by way of accepting a bill. So settlement by way of bill of exchange, right? So also accepted. NEFT, credit card, debit card also adjustable, available. What is called book adjustment? A and B. A sold goods to B. For that B has to pay, say, 1,000 rupees. Sometimes later, A purchased some services from B. For that A has to pay rupees 50. So 1,500, right? So for the goods supplied from A to B, 1,000 rupees is payable. For the services received, and A has to pay 500 rupees. For this, what is the journal entry? In the balance sheet, A will show B being what? Debtors, 1,000 rupees. For this, what happens? B will be shown as a creditors, 500 rupees in the liability side. Now you can mutually cancel these two and write 500 rupees, right? So net being 500 rupees. Maybe this is 1 lakh. Okay, 1 lakh, this is 50,000 rupees. Now what happens? The adjustment entry, B being my debtor is cancelled. So to cancel the debtors, I am crediting. To cancel the creditor, I am debiting. So B being the creditor, B being my debtors. Mutual amount is cancelled. Later on, I have to recover only 50,000 rupees from him. Only 50,000 from him. Is that clear? Hope now you will be able to understand this part. So really there is no any cash transaction. So it will be comfortably accepted to do deductions in your books, right? So payment to RBI, banks, cooperative bank, LIC, credit society, government is allowable, and payment by way of LOC, TT, BOE, NEFT, credit card, debit card, book adjustments over. Now, in case of purchase of any agricultural or forest produce, fish, horticulture, apiculture. Okay, in these cases are allowed. All the payment is given to the cultivator, grower, or producer, farmer. They don't have a manufacturing structure like. So, if I am being a big retail trader, I am purchasing the forest produce and fish and displaying in my store and selling all those things means automatically the sales should be in the form of cash. I mean, it's non-cash. But if I'm directly making the payment to the farmers and forest produce seller, cultivator, grower, or producer, then of course I can make the payment in the form of cash. Third one, this is allowed. And payment for purchase of products manufactured without aid of power. Cottage industry, they are manufacturing the what's that, camphor and all, sambrani, right? Camphor and udubati or dhoop. So all these things are manufactured where it is manufactured using non-power, okay, without the aid of power, and purchasing from them and making the payment. Of course, requires no compulsory account pay check or bank payment. If I want to make the payment to any people living in village or town where there is no bank service, there is no bank at all. So in Kodaikanal also there is a village called Vellagavi. Okay, around 40 or 50 families residing there. That's all. Okay, so I thought to go for a trekking there once, and it was unplanned, so we could not reach that place. Okay, it was around. We started around 10 o'clock, I think, 10 to 10:30. We went up to 4-5 kilometers downhill, and it was heavy rain. Immediately returned. Okay, even though we felt tired while returning from there, it takes around 6 hours, I think. I think so to reach that Vellagavi village. Okay, no supply of power, no electricity, no road facilities. You have to go in the trial only, that what God trial. Okay, now they are planning to go for paving the roads. Okay, we don't have the banking facilities. No internet connection, no electricity also properly available there. Then no road facilities. Nothing is there, right? How will then expect bank to be operated there? So if I want to make the payment, their main source of income is selling the forest produce. All the forest produce they collect from their forest and coming to the plains and sell and return. Okay, that's how they do the business. For them, we can pay the money only in the form of cash. Payment made in some people who are living in village or town where there is no bank operations. In case of payment to employees, the two terminal benefits at the time of resignation. Okay, at the time of resignation, terminal benefit, retirement benefit paid as a single short payment. If it is less than 50,000 allowed, then the limit is increased from 10 to 50,000 rupees. And in case of transporters, okay, so if the transporter furnishes PAN number, you can increase the limit to 35,000 rupees. Lorry driver, I asked to supply my shift my items from one location to the other location. The lorry driver expects the money to be settled only in the cash. Why? Sir, I may travel for a long distance here or there. I don't have the internet facilities to petrol my lorry, diesel my lorry, or to do some emergency services. I need only in cash form, sir. I cannot expect the cash. So for them, the limit is increased to 35,000 rupees. Usually the limit is 10,000. Two places the limit is increased. One is terminal payment to the employees up to 50,000 rupees, and the transporters, the limit is increased to 35,000 rupees. That too, in the transporter case, you have to get the PAN number from them, only can be deductible. Eighth case being salary payment to employee, similar to this one, but where the employee temporarily posted in some other location where the employee has no bank account. So 15 days or more, other place or shipped where the employee has no bank account. Usually, employee resides in Trichy, suddenly he was transferred to some other location, maybe Kanyakumari for some period. So he was asked to stay there for 20 days. So he says that I don't have the bank operations there, sir. How can I manage? Then you can make the payment in the form of cash. But today, one bank, one nation. Wherever you can go and you can withdraw. So this will be now least important, right? Eighth one is over. Ninth one, payment is required, but bank closed on holiday. You have to make the payment on 15th August. 15th August is the deadline to settle the payment, but 15th August is a holiday. What can we do? In that case, you can of course make the payment due to the holiday or strike on the date. And 10th being payment is made by an authorized dealer or a money changer. So if you want to go for a foreign travel, okay, foreign travel. So if you plan to go for UK, you need to have the sterling and pound. So for the pound, the euro, whatever it may be, if you go for Western countries, right, or dollar, where do you get that? Directly go for the authorized money exchanger, give 2 lakhs or 3 lakhs and convert the 2 or 3 lakhs into your dollar. In that case, you can make the payment in the form of cash, right? That too, the payment is given to the authorized dealer or money changer against purchase of foreign currency or traveler checks in the normal course of his business. So these are the items where you can make the payment in the form of cash, still you can enjoy the benefits of deduction. Other cases where disallowances would not be attracted: loan borrowing and repaying. If you are borrowing the loan and repaying, ninth, can we make on Sunday? Sunday also NEFT is operated currently, right? Sunday also NEFT is operated. Clear. If there is a specific due date, this particular date, see, always remember, when it's all about taxation, no. Sundays, holidays are, so I made the payment in the form of cash. Then you have to prove, if the question scrutiny comes from the department, you have to prove Sunday is the last date you have to make payment, and you came to know only in the morning of Sunday, and you have to give the proof that the Sunday is the cutoff date, and no other bank is operational on the date, and NEFT is also not working. You have to show all these things. What you can do then? Simply make in online, right? So there will be complication, always complication, right? Some provisions maybe seems to be implemented, but there are some trouble also we face, right? Loan borrowing and repaying, okay, but not for interest on loan. The loan borrowing and repaying is accepted, but at least the interest on loan should be payable in the form of account paycheck or NEFT form. Payment made to commission agent against goods received, not being goods purchased, okay. So A and a commission agent. A commission agent. A procures the material from various persons, and material is supplied here, and A demands to make the payment in cash. In this case, allowed. He is not the supplier. He is not the supplier. Supplier may be X, Y, Z. He is being the commission agent. So I asked him to supply some item. Commission agent says, no problem, sir. I will supply all these things. Give me the cash. So he procures from n number of different purchases and transfers the goods to me and collects the money and settles the money to the various sellers. In that case also you can make the payment. These are the exception case. Okay, exception case. You can keep this idea in your mind. Hope now you'll be able to understand section 40A class 3. Payment in the form of cash in excess of 10,000 is disallowed. So 3 more items to be completed. So with that, section 40A class 3A 7 9 also be completed. Okay, let's see here now. Now in your P&L account, your GP being 1 lakh, expenses paid being 60,000, where we have outstanding expenses also being 20,000 rupees. Now your net profit being 20. Am I right? This is for the previous year, 23-24. Now what about the scenario? This one is also allowed to be deductible. If the expenses remains outstanding, usually deductible, as we follow accrual system, except in case of interest, like some expenses under section 43B will be deductible only on payment basis. But in this case, outstanding expenses can be deductible under accrual basis. What happens the next year, again GP being 1 lakh, expenses completely paid being 70,000 rupees. Your net profit in this case being 30. Okay, seems to be everything normal. But this outstanding expenses in the previous year, 24-25, paid in cash. Paid in cash. How much? 20,000 rupees. You are aware about that. If these expenses paid in cash in the year 23-24 disallowed, right? He says that I have not paid this amount at all. He says it's being outstanding. Payment in cash excess 10,000 is disallowed, but here it's not paid, it remains outstanding. It remains outstanding. So I claim the deductions, but the next year, this fellow, without showing this in accounts, makes this 20,000 settled by way of cash. Makes this payment paid in the form of cash. That seems to be cheating, like no. So immediately one more new section is introduced. If the payment is made in the form of cash in excess of 10,000 is disallowed, and you claim the deductions keeping this being the outstanding, and next year you paid that money in the form of cash, in the next year it is disallowed. So in this year 24-25, net profit as per the books being 30,000 rupees, add disallowed expenses under section 40A class 3A. This 20,000 is disallowed. 50,000 will be the taxable profit in the next year. Section 40A class 3A, when outstanding liability of the earlier year is paid in the current year beyond 10,000 other than by way of account paid check, is disallowed in the year of payment. In the year of payment. Hope now you'll be able to understand this one. Now, two more things. Amount not deductible in respect of provisions of unapproved gratuity fund. Approved gratuity fund, you can claim the deduction under section 36 class 1, right? Where we have seen superannuation fund and PF fund and gratuity and all, section 36 class 1 subclass 4A 5. 4 is all about RPF and superannuation fund. 4A is all about NPS, 5 is all about gratuity. In those cases, only in case of approved can be debited in the P&L account subject to section 43B payment basis. But under section 40A class 7 says, if you are making any provision for the unapproved gratuity, then not deductible. That is not deductible. Even the provision is created as per the actuary valuation, not deductible. Okay. But if you are making a provision for outstanding gratuity, then deductible. The actual gratuity is supposed to pay. Okay, confirm that amount is supposed to be payable and you created a provision for that outstanding debt. Then it can be deductible. Usually, you understand that a rough calculation provision for the future payment of gratuity is not deductible if it is being unapproved. And non-deductible in respect of the contribution to non-statutory fund. Non-statutory fund. There is no legal requirement. If you are depositing that, that will not be deductible. Is that okay? So you know that NPS, how much is deductible? How much is deductible? Up to 10% of salary is deductible. Am I right? We have studied under what section? Section 36 class 1 subclass 4A. 4A. Is that okay? Beyond this, above 10% of salary is considered as unapproved. This part is disqualified under section 40A class 9. This will be disallowed. This is deductible. Go and refer that section here. Okay, deduction is restricted to 10% of salary and disallows NPS contribution in excess of 10% of salary as per section 48 class 9. So some of the sections you will not be able to understand while studying that because it may be explained in detail in the subsequent classes. So once all those things are over, then you have to go for revising. So that in case of taxation, you have to do multiple times of revision. So only can be mastering this. Right. So what are the unapproved scheme? Unapproved gratuity, unapproved superannuation fund, unapproved provident fund, NPS contribution in excess of 14%. Sometimes it may be 10%, sometimes it may be 14%. For the central government contribution, it is 14%. Okay, in all other cases 10%. Anyhow, we'll study all these things in detail along with section 80 CCD later on under deduction chapter. Clear? With that, we have completed section 40A class 9. So in 40A series, we completed with 2 unreasonable payment and 3 cash payment in excess of 10, and 3A payment is deductible on accrual basis. Later on paid in cash is disallowed. And 7, some provision creating for unapproved gratuity or gratuity is not deductible. And 9, any unapproved or non-statutory fund contribution is disqualified always. Clear? This one is provision. It's an actual payment. Though it's actual payment, it's a not legal payment, non-statutory payment. Now, section 41. Already we have completed 3 of this section. One is all about 41 class 2 balancing charge, 41 class 3 sale of assets used for scientific R&D, 41 class 4 recovery of bad debt. Of course, you can simply skip these two for CA interlevel. So you better understand section 41 class 1. You have claimed any deductions in the previous prior to the previous year. Later on you recovered that amount, then on recovery that will be your income. For example, in your P&L account, your GP being in the previous year 23-24, GP being 1 lakh, and your normal expenses being 60,000 rupees. You are asked to participate in government's exhibition. You too participated in the government exhibition to display your commodity and all. For that you have to rent the stall. Maybe government charged around 30,000 rupees. Government charged around 30,000 rupees. Exhibition rental. Okay. Then your net profit as per the books being only 10,000. Clear? Only 10,000 rupees. So this exhibition rental you paid no. Because of that you didn't get any business, completely damaged, only 5,000 rupees recover. Doing the business and made profit only 5,000 also included here. In the previous year 24-25, okay, again government calls for participating in another exhibition. Every year they are conducting. All the business people agitated. Sir, last year we paid so much. Our business was totally collapsed because we expected that you will start the exhibition during the summer holiday. You started exactly at the time of public examination. No one came. How can we do the business, sir? We lost. As the representation from the trade union goes to the government is now considering, oh, is it so? Then no problem. I will return a part of this. Out of 30,000 rupees, I will release around 25,000 rupees. Okay. So it's a compensation, like the government refunds the money. Now the profit and loss in this period being gross profit 1,20,000, other expenses being 90,000 rupees, your net profit being 30,000 rupees. Now what happens here? Net profit as per the books 30,000 rupees. An amount claimed as deductions the previous year. Later on, if you are recovering this amount, will be considered as your income, deemed income under section 40 class 1. Receipt of deductions claimed earlier. Then now taxable PGBP in this case being 55,000. This section 41 resembles like same. We debited the depreciation on sale of the asset if you gain any income to the extent of depreciation will be balancing charge. Any amount earlier debited on recovery is your income. For the scientific warranty, earlier I purchased a plant and machinery and debited the amount in the P&L account. Now on sale, I recover any amount to the extent of amount debited will be considered as your income. Scientific warranty. Bad debt, you consider this being the amount not recovered and debited in the P&L account under section 36, class 1, subclass 7. Later on, if you are recovering that, then on recovery, it is your taxable income. The same logic, any other than these three, balancing charge, scientific warranty purpose item, and then third one being bad debt. Apart from that, any other expenses earlier debited, and later on, a compensation or subsidy or the same amount recovered later on will be considered as your deemed income under section 41 class 1. Right. Now, apart from that, in case of working capital loan, any outstanding expenses, sometimes the government may waiver it. Okay, then it is income considered as taxable under section 41 plus 1. But if the same loan taken for asset, then automatically what happens? Loan for asset, that gets waived. It can be reduced from WDV of the block. Okay, so in your balance sheet you have loan. The loan is for working capital as well as for purchasing any asset. Okay, probably 100, probably 50. If this 100 is waived, what you can do? In your P&L account, you can consider this being income. What about this one, sir? If this 50 is waived, from the WD value of the asset, maybe 500, from there this 50 is subtracted. Thereafter, you can claim the depreciation only on 450. Only on 450. So, working capital loan and outstanding expenses waived, then income, loan for assets, block of asset, then such loan reduced from the WD value. If the loan is common, not for any purpose, then no effect, like bank overdraft, simply not for any purpose. General loan you borrowed cannot be adjusted anyway. So these things are falling under section 41. Section 40. Clear? So we have completed 2, 3, 4 and this 2 not required. Okay. So 43, 1 we have completed and 43 A completed and 43 B also completed. So almost I am going to complete majority cases. The last provisions, thereafter we have to go for the tax computations calculations. Now, section 43 CA, transfer of land and building consideration. Transfer of land and building consideration. Okay. Now, SSA builders, okay, they purchased 10 flats at rupees 50 lakhs each. 500 lakhs. Sale. Okay. 8 flats sold at rupees 60 lakhs each. 480 lakhs. And remaining unsold flats, 2 flats at 50 lakhs each. 100 lakhs. Then the profit being 80 lakhs. Am I right? That's how they have shown. Now, on sale of the land and building, this is flats or land and building. In case of sale of land and building, sale consideration is equal to whichever is higher of actual and stamp duty value on transfer. Okay, for the registration purpose, you have to buy the stamps and prepare the deed. Okay, for the stamp duty calculation, there will be a value. You have to always cross verify if the actual price being per flat 60 lakhs as per the earlier P&L account, but stamp duty value says it is 70 lakhs. Then what is the actual sale consideration? 70 lakhs will be taken. 70 lakhs will be taken. Whichever is higher will be taken. Automatically, if you are increasing by 10 rupees for 8 flats, another 80 lakhs will be addable with the net profit. You have to pay the tax on 160 lakhs. This is as per which provision? Section 43 CA. That too the flats here, flats, land and building. Okay. Held by SSA building as what? Stock in trade. Stock in trade. Sir, but I'm not a builder, sir. I have purchased a property. Already I have my own family owned property worth rupees 101 crore. I want to sell it for 100 and, 1 or 2 crores or 150 crores, 100 1.5 crores like I plan to sell. Will this be applicable, sir? It is not my stock in trade. If it is not stock in trade, automatically it always be applicable, but under section 50C. Okay, we'll study that along with section 50C. In case the asset transfer, the land and building transfer being capital asset, automatically the same provision is applicable, but under section 50C. If it is being stock in trade, it will be applicable under what section? 43CA, otherwise 50C. So I will again teach this, keeping this being the capital asset under section 50C later on. Clear? Hope you will be now able to understand. Sir, what happens, sir, if the sale actual being 60 lakhs, sir, stamp duty value is only 55 lakhs, sir. Then also you can take 60 lakhs. Of course, there will not be any impact in the net profit. There will not be any impact in the net profit. Now, here, actual being 60 lakhs, but the stamp duty value be 65 lakhs. Come on, tell me. What value? So here 60 lakhs. Why? Because one more point I am going to guide you here. This section 43 CA is not applicable when if stamp duty value is less than or equal to 110% of sale consideration, actual sale consideration. 60 lakhs multiplied with 110% is 66 lakhs. Actual is only, sorry, stamp duty value is only 65. So stamp duty value is 65 lakhs. 110% of sale consideration being 66 lakhs, less than or equal to this one. As this condition is satisfied, that section 43 CA is not applicable. Applicability applies to transfer of land and building, excluding capital asset. In case capital asset, similar provision will be applicable under section 50C. That too, it is held as stock in trade, then section 43 CA will be applicable. Here the sale value will be deemed sale value is stamp duty value exceeds the actual consideration. Means stamp duty value or actual consideration, whichever is higher will be taken. Stamp duty value is deemed to be the sale consideration. Okay. Tolerance limit. How much is this one acceptable? That say actual will be taken rather than stamp duty value. Otherwise, section 43 CA is not applicable. No adjustment if difference is within 10% of the actual consideration. If the difference is within 10%, of course, this will not be applicable. So, hope. One more point. Here, SSA builders and Mr. A. Flats transferred, consideration 60 lakhs. Consideration 60 lakhs. But payment is made, okay, on 1/7/2024, 10 lakhs. and registration and balance payment made on 1/1/2025, 50 lakhs. Payment and registration is handed done. Payment and deed written in this regard. Okay, that too payment should be not in the form of cash, not in the form of cash, account paycheck. So he has made a small advance amount, that too made in the form of net RTGS on 1/7/2024. The balance amount paid at the time of registration on 1/1/25. Now the stamp duty value being 55 lakhs on this date. At the time of registration, the value is 75 lakhs, 60 lakhs, but stamp duty value being either 55 or 75. Which one is taken? Always remember, even a small amount transferred and for the balance amount, a small draft is made agreed between these two parties. The transfer is not in the form of cash. Then that date stamp duty value is final. You can take 60 or 55, whichever is higher. 60 lakhs will be your sale consideration. Sale consideration under section 43CA. Clear? So from this it is very clear, even small amount transferred in electronic form or mode, plus there is a small agreement, then automatically that will be final. You no need to consider the other stamp duty value. This is not required to be taken. This is not required to be taken. Sir, what happens, sir? This is settled in the form of cash, sir. In the form of cash, then I will not consider this part. I will consider the stamp duty value on the date of registration. So I have to compare this to 60 and 65, 75, whichever is higher, 75 will be taken. Is that okay? Is that okay? Hope now you will be able to understand. If you have been given multiple stamp duty values, and which value will be taken? Even small amount transferred in electronic form along with the draft for the balance to be payable, then that date stamp duty value will be taken. If it is not so, registration date's stamp duty value will be taken. Stamp duty date. Stamp duty as per the agreement date applies if advance payment is made via account paycheck. Advance payment is also there and agreement also made on the date. And this advance payment is in the form of account paycheck, draft electronic form, then this date is final. If this is missing, then registration date will be taken. Okay. Even sometimes stamp duty value, your actual consideration being 100 lakhs, stamp duty value is 200 lakhs. So what is your sale consideration? Stamp duty value only. You have to pay the tax based on the stamp duty value only. Clear? Actual consideration 100, stamp duty value is 200 lakhs. You have to pay based on 200 lakhs only. Clear? But available at 200 lakhs, I am sure. But particularly my property in a corner place, and the path is very narrow. No one buys, so I want to sell at much lower than the market price. What can I do, sir? So he now argues that so I cannot sell it at this rate. Okay, nearby, normally it is saleable at 200 lakhs, I am sure. But in my property, the property located in such a way we cannot sell it at all. So to compromise my sale price, I reduced my sale price and sold for 100 lakhs. Okay, is it so? Yes, sir. Then it can be referred to the valuation officer. It can be referred to the valuation officer. Then the situation goes to the valuation officer. He says, yes, sir, it cannot be saleable beyond 120. Okay. Or he may say, it may be only 80, sir, not more than that. Or he may say, no, sir, he is lying. It may be saleable for 250. That's how the valuation officer may give the report. What happens in this scenario? So, in case reference, the assessing officer refers the situation as per the request of the assessee to the valuation officer. Either it is as per the assessing officer request, or voluntarily he can refer to the valuation officer. Assessing officer is the person to assess your taxable income and ask you to pay the tax. Valuation officer supports that whether the actual value is worth or not. So he may go and cross verify with the valuation officer. Right. Actual sale consideration being 100, stamp duty value being 200. Now, as per the AO's recommendations or reference to the valuation officer mentions the value as 80, sir. What can we do, sir? If valuation officer value is given between these two, whichever is lower will be taken, and between these two, whichever is higher will be taken. Let's see, between these two, whichever is lower is 80. Thereafter, refer actual and this one, whichever is higher will be taken. This is final. Suppose actual being 100, stamp duty value 200, valuation officer reports it is being 120. So valuation officer gives a report. It's a standard rent, like it should be cross verified with the stamp duty value. The stamp duty value should not be more than this one, so restricted to 120. Okay, standard rent, like here we have the valuation officer's value. Stamp duty value or valuation officer value, between these two, whichever is lower will be taken. So within whichever is lower is 120. Now you compare 100 and 120, whichever is higher will be taken. So 120 will be your sale consideration. Last scenario, actual being 100, stamp duty value being 200, but the valuation officer says, sir, it's really worth, sir, 240 lakhs. Then between these two, whichever is lower, 200 will be taken. And compare 100 and 200 rupees, whichever is higher will be the sale consideration. So the last point is all about valuation officer's value. See, valuation officer, if referred, not always. If there is a doubt, assessing officer can voluntarily refer, or as per the request of the assessee can also be referred to the valuation officer. If it is referred to the valuation officer, that stamp duty value cannot exceed the value determined by the valuation officer. It means stamp duty value or valuation officer's value, whichever is lower, will be taken, and then you compare with the actual revenue, actual sale consideration. This is the logic. Hope 5 points you have to keep in your mind along with section 43 CA. So what are the 5 points? One is it should not be capital assets, it should be land and building. Okay, immovable property, not being the capital assets. Second being the deemed sale value will be equal to stamp duty value if the stamp duty value is more than actual consideration. Third one is there any relaxation, sir? Yes. If the stamp duty value is within 110% of the actual cost, then X means the excuse is given. You don't need to consider 43 CA. And the last one being, which dates stamp duty value will be taken, sir? Which dates stamp duty value? Small amount also transferred as an advance through account pay check or electronic form, along with the registration or small deed that the balance will be payable later on. Okay, then that date stamp duty value will be taken. Else, registration date stamp duty value will be final. The last one is, if there is a doubt with respect to the, he himself refers the situations to the valuation officer, the assessing officer can refer to the valuation officer, or the assessing may request to refer to the valuation officer. If referred to the valuation officer gives a value, then this value will be compared with the stamp duty value, whichever is lower will be first taken, and then compared with the actual sale consideration. Between that, whichever is higher will be taken. Is that clear? Hope now you will be able to understand. And the calculation part, no, this 43 CA along with the 50 C, even under section 56, income from other sources, it's a big study. You have to club these three sections in detail along with income from other sources chapter, so that we'll be getting mastery over that. Here I just gave small proviso. 43 CA, 50 C. There I'll give examples also. And in section 56, income from other sources, I incorporate all these things. Clear? Hope now you'll be able to understand this concept. Any doubts here? With that, all the provisions are over. Now finally we'll go for taxing. How can we calculate for the tax? Taxable income. Clear? If it is clear, text me. Online students. Now, come on, remember the sections what we have covered up to now. So we have completed section 28, 29, 30, 31, 32, 33 AB, 35, 35 AD, and 35D, deductions for preliminary expenses. DDA is not there for, I think, for CA, so I skip that. Section 36, we covered 3, 4, 4A, 5, 5A, bad debt. 9th, promoting family planning and STT and CTT completed. General deductions completed. Section 37 2B, advertisement in any souvenir brochures in political parties magazines not deductible. Section 40A, specific disallowances. 40B, disallowances and allowances for firms and LLP completed. 40A class 2, related to unreasonable payment to the relatives. 40A class 3, cash payment for any expenses in excess of 10,000. 48 3A also completed. 41 deemed income set we have completed. 43 CA, sale consideration will be whichever is higher of actual sale consideration stamp duty value completed. We have to complete another 5 more sections so that entire content of PGBP will be over. Clear? Let's now brief one concept here and then we'll break. Then remaining will be continued later on. Section 44 AA, do I want to maintain the books of accounts properly or not? If you go to the street vendor, will he maintain the books of accounts? Ledger? No. Even petty shops, they don't maintain the books of accounts. Then who has to maintain mandatorily will come under section 44 AA. So as per section 44 AA, 2 classifications are there. One is professionals, another one is normal business. Okay. So there's a limit. If your transaction or profit exceeds that limit, you have to maintain the books of accounts. So here I'm going to discuss all those points under section 44 AA. 44 AA. Okay. So under section 44 AA, maintenance of books of accounts compulsory when in case of professions or other assessee. In case if you are calculating for the professionals, professionals mean any person working for law, advocates, engineers, company secretary, medicine, doctors, technical consultancy, accountancy, architectural, film artist, interior decorator, even any others may be notified now and then in CBDT. Okay, Central Board of Direct Taxation. They are called professionals. In these cases, if their gross receipt is more than 2.5 lakhs in all 3 preceding years, then automatically what happens? They need to maintain the books of accounts compulsorily. Okay, current previous year being 24-25. Okay, so prior to that being 23-24, 22-23, 21-22. In these 3 years, here also 3 lakhs, here also 3.5 lakhs, here 2.75 lakhs. Then they have to maintain the books of accounts here. Here 10 lakhs, here 2 lakhs, here 20 lakhs. What about these scenarios are not required to be maintained? In the last preceding 3 years, no. In all the 3 preceding to the previous year, their gross receipts, now I'm not talking about the profit, gross receipt exceeds 2.5 lakhs, then they have to maintain the books of accounts in this year onwards. Suppose it is not existing companies are newly started. In the very first year itself, they expect their revenue will be, receipts will be more than 2.5 lakhs. What can we do, sir? Then in the very first year itself, they have to start maintaining the books of accounts. Newly set up professions, if gross receipts are likely to exceed 2.5 lakhs in the same previous year. Then also existing one, 3 years limit is there. If it is newly started, verify whether you are able to cross the 2.5 lakhs in the very first year itself. Yes sir, then you have to maintain in the very first year itself. Specified professions. Now we'll go for the other assessees. We'll go for the other assessees. Okay, in case of other than professionals, PGBP is more than 1.5 lakhs, 1,20,000, or gross receipt is more than 10 lakhs, any of the three preceding the previous year. So here your PGBP being here 1.5 lakhs, 1.1 lakh, and 1.6 lakhs, 1.1 lakh, and 0.4 lakhs. Wants to maintain the books of accounts? Yes sir. Any one of the three preceding the previous year, if the PGBP crossed 120, then they have to maintain the books of accounts. Or their gross receipts. Gross receipts. Here it is 8 lakhs, here 9 lakhs, here is 5 lakhs. What about the scenario, sir? Not required. Clear? Hope now you'll be able to understand. Now, newly set up business profession, the same condition will be applicable. In case if it is by individual and half, the limit is slightly different. Income rather than 120, it is 2.5 lakhs. Rather than 10 lakhs, it is 25 lakhs. Requirements: maintain books as per the rule number 6F or as required by the AO. You have to maintain the books of accounts as per rule number 6F. Okay, rule number 6F. What is that? Rule number 6F is nothing but all the things what you prepare in bookkeeping and accounting: cash book, journal, ledger. If you are selling, you have to give the receipts, bill. For that, you need to maintain the carbon copies if the sales revenue is more than 25 rupees. If you spend, you need to get the receipt, bill. Okay, original bill for the expenditure exceeding 50 rupees. In case of spending, you need to have the original bill if the spending is more than 50, or you need to prepare a voucher. Okay, in case of selling, you need to maintain a carbon copy, because original bill is given to whom? To the buyer. So all these things are the mandatory requirement to be maintained as per rule number 6F. In case of medical practitioners, okay, additional books. In addition to this, they have to maintain daily case register. Who are the patients are there, and what are the treatments you've done? You have to maintain all these things. And medical inventory. What are the medicines you have? All these things are also be maintained in case of medical practitioners. Sir, if I don't maintain, what happens, sir? Failure to maintain the books attracts penalty 25,000 under section 271A. Okay, 2.5 lakhs. So 25,000 penalty will be leviable if you don't maintain the books of accounts under section 44AA. Now come on. Vinod is a person carrying profession as film artist. His receipts from the professions are as follows. Current previous year being 24-25. What is the obligation regarding the maintenance? Being in profession, his gross receipt should be more than 2.5 lakhs in all the three preceding to the previous year. Here, no, but here is yes, here no. As all the three preceding years, their gross receipt should be more than 2.5 lakhs. Not required to maintain the books of accounts in this year. Okay, so rest of the 4 more sections, 44 AB, AD, ADA, and AE will continue after this. So we have 4 more sections. Section 44 AB, AD, ADA, and AE. And AE along with one illustration. We'll directly go for solving the illustrations first of all. Then we'll cover up those 4 more sections. Okay. We'll start with the practical question number 2. One will finish a bit later along with 44 AE. Now, following is the profit and loss of Mr. Q for the year ended 31st March 25 given. Compute the income chargeable under the head PGBP. Okay, for the year ended 31st March 2025, ignoring deposition. How can we calculate? The computation of capital PGBP is given under section 29. You can recap that. Section 29. We'll start with net profit as per the books. As per books. How much is that? 93,950. Now do verification of all the items debited and credited in the P&L account along with the provisions we studied under sections 30 onwards. In the credit side, of course, gross profit as per the PGBP, we calculated that it will not be a matter. Interest from company deposits. So this will be falling under income from other sources, not under section 28. What are the items will fall under section 28? We have been given a list, right, in section 28. Related to the business, but this 6,400 is not related to the business, so I have to remove this. If I remove, what happens? Profit will decrease. So minus interest on or interest from deposits. This value being 6,400 minus 8. Minus 8. Income tax related, nothing will be shown in the books of accounts. Okay. So this is also disallowed. If I remove this, what happens? The profit will increase as a decrease. Minus IT refund. IT refund. The value being 8,100. Okay. If I remove, then this will reduce and ultimately net profit will reduce. Repairs and building allowable related to the building expenses can be claimable under section 30. Amount paid to IIT Mumbai for an approved scientific research program. So this will be claimable under section 35. So first this will be disallowed and then you can claim the deduction under section 35. Or we assume this 1 lakh is as per section 35 only. But that too, they have to shift out of the default tax regime. Okay. If they follow default tax regime, of course, this cannot be claimable. If they follow shifting out of the default tax regime, the deduction is correct. No need to do adjustment. Interest can be deductible under section 36, class 1, subclass 3. Traveling may be related to the business revenue nature, deductible under section 37, class 1. So each and every expenses or income debited and credited in P&L account can be verified with the provisions what we have learned here. If all these things are properly maintained, no need to do any adjustments. If it is not so, you have to remove it. Following additional information is furnished. Repairs and building include 1 lakh being cost of laying toilet roof. So this 1,81,000, you know, 1 lakh related to toilet roof be considered as capital expenditure. Balance will be the revenue expenditure, 81 being revenue expenditure. So under section 30, any repair expenses being the revenue can be deductible. Capital expenditure cannot be deductible, but it can be forming part of the actual cost for the depreciation calculation under section 32. But anyhow, here it is clearly stated, you can ignore the depreciation on this. This 1 lakh cannot be debited here. If you remove this 1 lakh, rather than 181, if you debit only 81, what happens now? What happens here? Your profit will increase. So add capital expenditure related to the repairs of building. Okay, the value being 1 lakh is added back. 1 lakh is added back. Interest payments include 50,000 on which, okay, interest payments include interest of 50,000 on which TDS has not been deducted. So this interest 50,000, for that TDS is missing. TDS missing means as per section 40 class A, it is disallowed. and penalty 24,000 for contravention of CGST, and another 24 under section 37 class 1. Am I right? So because of these reasons, these two are disallowed. So if you remove that, the profit will increase. Interest without TDS. Without TDS disallowed under section 40A class what? 1 or 1A? 1A maybe. Because the interest is paid to the resident like. Then how much is disallowed? 30% is disallowed. 30%. Are resident outside India or non-resident, then 100% disallowed. Right. So we have two sections. 40 class A subclass 1, where the payment of interest fee for technical services and royalty to non-resident or anybody outside India, then 100% disallowed. 1A, payment to the resident, automatically only 30% disallowed. In the text, it is assumed that it falls under the first category, 100% is disallowed. So you can assume your own. You can assume 30% disallowed also be correct. So here the value being 50,000. Another one is penalty payable for violating the GST law. GST law cannot be deductible. So add it back under section 37 class 1. The value being 24,000. IT refund. Always remember, in case of income tax related item, always be excluded. Any income tax you pay will not be deductible under section 40A. And even if you are getting it refunded or interest payable for the delay, all these things are disqualified. In case of indirect taxation, of course, considered. IT payment is also not considered, and refund also not considered. Clear? So hope now you are able to understand this one. So Mubarak. Okay. Now what is the final value? I think total value 2,53,450. This is what about the PGBP income. Income from other sources. There you can add this 6,400. IT refund is not taxable. It's an appropriation, and receipt also you no need to pay the tax. Okay. This is nothing but interest. If you add up these two, then you will get gross total income. Okay, which is not required, but we need to calculate only PGBP income. So we have completed. Clear? Hope now you will be able to understand this logic. Clear? Text me. Yeah, interest payable without TDS is disqualified. Okay. If you pay the interest, applicable TDS should be subtracted. If the TDS not subtracted, then you cannot claim the deduction. We have studied that under section 40A class 1. 40 class A subclass 1. Specific disallowances. Interest, royalty, fee for technical services or other payment to non-resident or payable to anybody outside India without TDS deducted or TDS deducted not deposited before the due date of filing of return of income. Then what happens? This will be disallowed to be debited. You cannot debit this. If you don't debit this, then automatically profit will increase. Either you can consider this being section 40 class A part, or here payment made to resident. Okay. In case of the same interest is paid to the resident, only 30% is disallowed, not full value. Anyhow, Anyhow, we'll study these things later on. That's how I told you, right? Because all these provisions, no, we'll study along with the TDS chapter. TDS chapter. And for the income tax related, income tax includes cess and surcharge and interest, cannot be deductible. And on refund also, it's not income. On refund, it's not income. On payment, it's not expenses. Is that clear? So all the provisions what we have learned up to now, you have to be master with that. So applying those things, you can calculate the taxable profit here. The computation of taxable profit is as per the steps involved in section 29. Clear? Let's now move on to the next illustration. Mr. Sivam, a retail trader of Cochin, gives the following trading and profit and loss. So we have been given net profit here. We start with net profit as per the books. As per books. 50,000 rupees. Okay. Computation of PGBP. In the credit side, sales okay. Income from UTA is not part of business income. You invested in UTA, you get any returns from UTA is nothing but income from other sources. Should be removed. Income from UTA. Income from UTA. 2,400 should be subtracted. Other business receipts, I am not sure. Closing stock, everything is okay. In the debit side, what happens? Opening stock purchases, gross profit, sales, salary, rent, interest on loan, okay. Depreciation, printing and stationery, other general. Short-term capital loss on share. It's a part of short-term capital gain or capital gains. So it should be removed. If I remove, what happens here? Profit will increase. Short-term capital gain or loss. In this case, it's a loss. Loss should be added back. Loss should be added back. Clear? In other cases, okay. Point number 1 onwards. 3 points I'll take. Come on, tell me. It was found that some stocks were omitted to be included in both opening and closing stock. Closing stock should be higher. Naturally, 9,000 closing stock should be higher. Or you can understand this way only. 9,000 missed to be included here. 18,000 missed to be included here. Now, if we include 9,000 in opening stock, what happens? Debit side increases, profit will decrease. So, you have to reduce the profit minus increase in opening stock. Because of this reason, your profit will decrease by 9,000. In case of closing stock, if you increase, it's a credit item, it increases your profit. So, increase in closing stock. This value being 18,000. This value being 18,000. Okay. 8,100. Okay. This is 8,100. Okay. Salary includes 10,000 paid to his brother, which is unreasonable to the extent of rupees 2,000. Salary. Out of this 60,000 rupees, 10,000 meant for his brother, where there is unreasonable extent of rupees 2,000. Should be removed to that extent. Add back. Unreasonable salary to brother. Salary to brother. Okay. Not deductible under section 40A clause 2. Now you will be able to understand why do I want to memorize the sections. If you are able to memorize the sections, you can cross refer easily. That's the advantage you have. Spare around 1 or 2 hours to repeat those around 20 or 25 sections again and again, so you'll become master with that. Right. Not all the sections, on basic sections you memorize. So here the 2000 rupees is disallowed. The whole amount of printing and stationery was paid in cash. This printing and stationery expenses 23,200 paid in cash. If you are making the payment of expenses in cash in excess of 10,000 is completely disallowed. So add printing and stationery expenses. Okay, disallowed under section 40A class 3, the value being 23,200 as the payment is made in cash in excess of 10,000 rupees. So I've incorporated 3 adjustments already. Fourth one, depreciation provided in profit and loss account to base profit and loss account being 1,05,000 was based on the following information. The written down value of the plant and machinery 4,20,000. A new plant falling under the same block of depreciation. So it's a plant and machinery. Block of asset carries 15% depreciation. Purchased on 1/7/24, 70,000 rupees. Purchased on 1st July, so eligible for full year's depreciation 70. 2 old plants were sold on this date minus sale for rupees 50,000 rupees. The ultimate value being 4,40,000. And applicable depreciation on this at the rate of 15% on this 66,000. This is as per section 32. So fourth one, as per section 32. So the depreciation in P&L account 1,05,000 is disqualified first. Okay, add depreciation as per book. As per book, 1,05,000. Then what you can subtract? Depreciation calculated as per section 32 can be deductible 66,000. 66,000. Is that clear? So 1, 2, 3, 4 over. Rent and rates include CGST liability of 3,400 paid on 7/4/25. So any payment to the government like taxes, duties and any other cess for that subject to payment basis can be deductible under section 43B only. Payment basis. Payment basis means it should be paid before the due date of filing of return of income. If no audit requires the 31st July, else 31st October. But anyhow, only 7 days later than the year end. So definitely it is eligible for deduction. No need to do any adjustments. But give a note. Allowed as the payment should be made before the due date of filing of return of income as per section 43B. So the payment is also made within the due date. So no need to adjust this. Other business receipts include 2,200 received as refund of sales tax. What about this one? Refund of sales tax. Income tax related items cannot be deductible, as well as any refund of income tax related item will not be considered as your income. But in case of indirect taxation, can be deductible as expenses on receipt. You have to consider this as income. So it is income only. Okay. Already it is included in the business receipts. It is already included in this. So you no need to do any other adjustments. Correctly they have done. As it is correctly done, you no need to do any other adjustments for this. Okay. Other general expenses include 2,000 paid as donation to public charitable trust. Donation is not business expense. In case of donation, contribution only falls under section 35, which is nothing but contribution to scientific R&D purpose. Okay. But here it is not scientific R&D purpose, so this is disallowed. This 2,000 rupees in general expenses is disqualified to the extent of 2,000. So add donation to public charitable trust. Okay, is disallowed. The value being 2,000. Clear? Now come on, tell me the overall value. 1,30,900 will be your PGBP. Now, actually, the tax rate applicable for this being 30%. So we have one more section called 44 AD. I'll explain that later. Presumptive taxation. As per the presumptive taxation, you no need to maintain all these books of accounts perfectly, and you no need to calculate all these things. Simply show your collection and verify whether the collection in the form of cash or other mode. If it is not being cash, only in the form of other mode, okay, you can categorize this into cash mode or other mode. Other mode means probably credit card, NEFT, whatever it may be. In that case, your income is equal to, your PGBP is equal to, in this case 8%, in this case only 6%. Okay, so what happens if you assume that entire 12 lakhs 11,000 is collected, 11,500 is collected by way of cash, your assumed income being 8%, and this, how much is that? 96,920. Come on, would you like to pay the tax on 1,30,000 or would you like to pay the tax on 96,000? Which is more preferable for you? Paying tax on the lesser income is more preferable, so you can simply shift to 44 AD. Okay, 44 AD. The 44 AD provision is applicable in this case. Is that clear? So we'll see all the provisions in detail. 44 AD. You can enjoy the 44 AD provisions where your turnover limit is less than or equal to 2 lakhs. You can have the options to go for 44 AD. You don't maintain any books of accounts. Okay, you no need to go for auditing everything perfectly. Just ask him, any customer coming to you or client, assessee coming to you to file the returns, ask him what is the total collection. So total collection, you bifurcate into collection in the form of cash and collection through account, bank account. And in case of bank account, only 6% will be considered as your income. In case of cash form, 8% will be considered as your income. Or club these two. This will be overall income for the taxation purpose. For that, you have to pay the tax. Come on, you forget everything. All the provision what you have learned is now removed to make the calculation simpler, right? Very simple, right? In your examination, if you are asked to calculate the tax on presumptive basis, it may be pretty simple. Just to take the receipts on that 8%, if the receipts being in cash. If the receipts being in means account format, only 6% will be your income. On that you have to pay the tax. Simple or not? So government is very interested to make the tax simpler. Means even a layman can file the tax he himself. Okay, then automatically trouble comes for the professionals like us. Okay, understand now. So they have the options to go for proper calculations or simply go for 44 AD. But of course, their turnover should be less than or equal to 2 crores. Clear. Probably coming days it may be increased to 5 crores also. Government is giving lots of relaxation to increase the limit. Up to 10 crores also in satisfaction some of the condition, audit not required. Audit not required means even layman can do all the accounting and filing the returns of income and pay the tax. Very simple. Clear. So what about the scope for us, sir? Okay. Once you become member, you will just go and attend the member meeting. Then the member will then start crying and you will listen all this thing. Sir, I resigned my job and hoping that I will get good cost audit, and I resigned my job from the banking sector. After 15 years of experience, I was supposed to go for manager posting, senior manager posting. But I resigned hoping that the cost audit will come. The next day, cost audit was wiped, not required. So they lose the jobs also. Okay, anyhow. So this is a case you have to understand. During the previous year 24-25, profit and loss account of Mr. A, proprietor of Free Bird Enterprises, engaged in the business of dye-made garments, shows a profit of rupees 4.5 lakhs. Net profit as per the books. As per the books. How much? 4.5 lakhs. With the following information, compute is taxable income from business. Interest on capital. You know that it's only appropriation, cannot be deductible. It's personal, like, so it should be now added back. A. Interest on capital. 15,000 added back. Purchase include goods worth rupees 15,000 from his younger brother in cash. However, the market value being 8,000. So here two sections are attracted. Section 40A class 2. If you are purchasing from the specified persons, relatives, excess payment will be disqualified. And the payment is in the form of cash, then 40A class 3 will be applicable. So out of 15,000 rupees value, first the market value is only 8,000 rupees. And 7,000 seems to be excess payment disqualified under section 40A class 2. Okay. Now, what about the balance now? 8,000 rupees. This is assumed to be payment made in cash. But the accepted amount or deductible amount made in payment made in cash is less than 10,000, right? So as per section 48 class 3, if the payment is more than 10,000, that too in cash is disallowed, but the means approved amount being only less than 10,000 rupees also paid in cash, this one is allowed. Clear? Suppose if the price being 25,000 and automatically 8,000, 18,000 will be the market value. In that case, the difference between these two, how much? 7,000 will be disqualified under section 40A class 2. Balance amount 18,000 paid in cash, right? As a payment made in cash, section 40A class 3 is applicable on that. Any payment in excess of 10,000 is also disqualified. So this is also disqualified, this is also disqualified. In this case, surprisingly, the accepted amount to be deductible is less than 10,000 rupees and that too paid in cash is not a matter. So B case. As per section 40A class 2, unreasonable payment is disqualified. Unreasonable. Okay. How much is that? 7,000 is disqualified. C. Interest paid outside India, 1 lakh. Without deducting tax at source. No TDS deducted. Then automatically section 40 class A subclass 1 will be attracted. C. Section 40 class A. Okay. Non-deductible due to no TDS. No TDS, so non-deductible. 100% is disqualified. Okay. Non-deductible if you are adding back. Okay, in case of non-deductible expenses, it should be added back. Penalty paid to government for non-filing of CGST return. It's a violation of Act disallowed under section 37 class 1. Okay, D. Section 37 class 1. Of course, referring this section is not required. You no need to note that section's name also. Okay, penalty for legal violation, legal penalty is not deductible. Penalty paid to customer for non-fulfilling of order within the time. As per the same section, this one is allowed. Commercial violation. Commercial agreement between the parties violated, because of that any penalty is payable, of course accepted. So in section 37 class 1, I have explained in detail both. If bad debt rupees 1 lakh, money has been advanced for purchase of building. Bad debt 1 lakh. This bad debt 1 lakh cannot be debited. Bad debt can be debited only when earlier it was considered as income and credited in the P&L account. But here, this bad debt is due to non-recovery of the advance paid for the purchasing of building. Any amount paid for purchasing the building is nothing but building advance to bank. That building advance is not amount transferable to the P&L account. It may be transferable to the balance sheet as an asset. Later on, that amount not recovered. So, it's not considered as income earlier. So, this is disallowed. F disallowed. So, disallowed means if it is already debited, you have to add back. F case. As per section 36, class 1, subclass 7, bad debt non-deductible. As the bad debt is related to non-recovery of advance money given for assets, 1 lakh. 1 lakh. G. Revenue expenditure on promoting family planning among the employees. G. Also be not qualified to deduct under section 36, class 1, subclass 9. Okay, subclass 9. Clear? Because this is a free bird enterprises, may not be company. Okay, it's a sole proprietor. Okay, so this section 36, class 1, subclass 9, promoting family planning expenditure, either it may be capital or revenue, can be deductible only for the company SSC. For others, it's not deductible. But if you prove that expenses for the business only, then you can claim the deduction under section 37, class 1 also, if you are proving. Means you get the subsidy and other things for the government for conducting the family planning promotion expenses, then you can claim the deductions. Else you cannot claim the deductions. As you are not eligible for claiming these deductions, you have to add back. So G. Section 36, class 1, subclass 9. Family planning expenses, not deductible. Not deductible. Applicable only for the company SSC. Only for company SSC. Right. H. Premium paid on health of employees. In case any premium payable for the health of employees, it should be in the form of, not in the form of cash, and group health insurance, and the insurance schemes approved. So these are the conditions we studied. Here, this is being in cash, so this is not allowable to deduct. H. Under what section? Section 36, class 1, subclass 1B. Okay. Insurance. Okay. Insurance for health. Not deductible, 6,000. I. Premium paid on health of his relatives. Also not deductible, though it may be check. Premium payable only for the health of employees under section 36, class 1, subclass 1B. Now it is for the relatives, not qualified to be deductible. Okay. H. And here I. The same section. Insurance for relatives, not allowable. Not allowable. Add back. Employer's contribution to RPF 12,000 rupees. Employer's contribution to RPF 12,000 rupees. 1/2 of the amount is paid after the due date as per the relevant act, but before this date. Employer's contribution can be deductible on payment basis as per section 43B. What says? What the section 43B says? Okay. You have to make the payment before the due date of filing of ROI. So it means 31st July. So they have paid every amount, all the amount within the due date. So you no need to claim, you no need to disqualify that. So what they have done is correct. But in case of employees' contribution, half of the amount is paid after the due date as per the relevant act, PF Act. As per the PF Act, it should be payable within the 15th of the next month. But here, 50% paid after the due date as per the relevant act, but before the due date of filing. Means 5,000 paid within the due date, another 5,000 after the due date of the relevant PF Act, but before the due date of filing of return of income. Means 15th April 2025 onwards, before 31st July 2025. It was paid between this period. But anyhow, in case of employees' contribution, section 36, class 1, subclass 5A is applicable. 5A is applicable. As per this section, you have to make the payment. Amount you collected from the employee should be deposited within the due date for the relevant act as per this section. Else, the amount collected will be considered as your income under section 2, class 24, subclass 10. So K, section 36 class 1 subclass 5A and section 2 class 24 subclass 10. As per this one, RPF not paid within the due date of the relevant act is disqualified. Out of 10,000, only 50%. 5,000 is disallowed. 5,000 is disallowed. L, interest on late payment of CGST 1,000 yet to be paid. Interest on late payment. What happens here? This one is allowable. This one is allowable. Okay. Because it is not tax, it's only interest. Interest will be deductible on payment basis only if the interest is payable to scheduled bank or financial institution or NBFC. This interest is not falling under these three category, and also it's not tax. To consider this will be deductible only on payment basis. So what they have done is correct. Accrual basis can be followed. Accrual basis can be followed. Now I'll continue rest here. Interest on loan from State Bank of India, scheduled bank, 10,000, 5,000 is not paid till the date of filing of return of income. Definitely it will fall under section 43B. So M case, section 43B is applicable. Interest not paid disallowed. Not paid disallowed. The value being 5,000. The value being 5,000. Interest on late refund from income tax department. See, income tax related items are disqualified, but if you are getting any interest on late refund will be considered as taxable income, but not under PGBP, income from other sources. It will be falling under income from other sources. Okay, this will be income from other sources. Sales include sales to Mr. A 10,000. Cost of such goods 8,000, market value of such goods being 12,000 rupees. In sales, they have included drawings. Sales include sales to Mr. A, Mr. A being the owner, proprietor. So if owner takes the goods, it's only a drawing subtracted from the asset and subtracted from the purchases. What is the entry for this? Drawings of debit to purchases. At what value you have to record? Only at cost 8,000 rupees. But it is shown as 10,000 is not required. You cannot make the profit by trading with yourself as per the income tax provision. So you have to consider only 8,000. 10,000 rupees you show no, you have to remove that. The excess 2,000 should be removed. If you remove 2,000 rupees from the sales value is decreasing, your profit is also be decreasing. So you have to do minus here. Item O. Okay. Now sales to oneself, sales to owner, drawings. Should be recorded at cost. Should be recorded at cost. Because of this reason, the excess revenue 2,000 should be removed. Automatically, profit will be decreasing. Minus 2,000. Minus 2,000. Is that okay? In text, I have given this way. The 10,000 rupees is added and actually 8,000 rupees is subtracted. This is how I have shown. This sales is excluded and cost is subtracted as an expenses. But I have posted here net value. P. He received 80,000 from the debtor at a time in cash. What happened this one? Okay. He received 80,000 rupees from a debtor at a time in cash. Accepted. Section 43A clause 3 is applicable only for the payment. For the receipt, even though it may be in cash, any limit will be accepted. Why? In case of payment disqualified, automatically rises the profit, you have to pay more tax. In case of revenue, if you are disqualifying, what happens? If revenue is reducing, you are paying lesser tax. Government will not allow you to pay lesser tax. In case of revenue, even in it may be in the form of cash, will be considered as revenue only. While making the payment, in case of excess payment more than 10,000 is disqualified. Recovery of bad rupees 10,000, out of which 2,000 was allowed as deduction during the previous year 23-24. recovery of the bad debt. Earlier year we claimed bad debt which is 2000 rupees. Only out of that we recovered the remaining 10,000. Means we recovered 2000 rupees. Okay. See, what does it mean? Actual amount being 1 lakh. We claimed bad debt under section 36 class 1 subclass 7 10,000 rupees, and we write down the debtors balance being 90, but income tax department say no sir, out of 1 lakh I allow only 2000 rupees, so 98,000 rupees. That's how shown in the taxation purpose. This is the actual demand expected, but this is how it is shown. Now what happens, we recovered this bad debt, what we shown in our books, we got this back completely, bad debt recovered. Now, to the extent bad debt claimed in the books, on recovery will be income under section 41 class 4 deemed income. Balance 8,000 was already not claimed as expenses. When you debit in your P&L account stating this bad debt, on recovery will be income out of 10,000 rupees, though you claimed the bad debt, but income tax department allowed to debit only 2,000. Later on, we recovered out of the entire, as per our calculation, 10,000, all the 10,000 recovered. But for the income tax purpose, only 2,000 will be considered. Only 2,000 is considered. So, this will be deemed income. Q. Section 41, class 4. Bad debt recovered. Bad debt recovered is income. 2,000 rupees. Should be added. Should be added. Okay. Then, depreciation being not debited in accounts. Depreciation being not debited in accounts 20,000 allowed as deduction. Of course, you can claim the deduction. Section 32, you can claim the depreciation as per the amount calculated under section 32 is deductible only. So 20,000 is deductible. Now find out the PGBP. Don't forget to minus these items. Okay. So automatically what happens? Your PGBP income is 6 lakhs 80, 89 or 88,500. Okay. Okay. So interest on late refund. Interest on late refund is income from other sources shown in the books. Shown in the books. Credit side. Then what you have to do? You have to remove this. Sorry. N. I thought it is removed already, but it is included in P&L account. This 500 is there, so you have to remove that 500 rupees. That will be part of income from other sources. So to remove, what happens? The profit will decrease. So here interest on late refund. Late refund of tax. 500 should be deductible. Hope now you will be able to understand. In P&L account, they have income tax interest on IT refund, late refund, 500 rupees. If you remove this, automatically what happens? Profit will decrease and it will be considered as a part of income from other sources. Now the ultimate PGP in this case being 6,88,500. Clear? Point P, point O is nothing but sales made to owner, means drawings, right? So the actual entry for this is what? Drawings to purchases. Okay. So then it will reduce the purchases. It should reduce the purchases. So if I reduce the purchases, what happens? Will have the impact. So instead of that, they have shown 10,000 rupees as sales. So you have to remove the sales. I think this number sign is different. This one is minus. This one is plus. Okay. Actually, you have to remove the sales value. You have to add the cost value. That's all. You have to remove the sales value. Sales to owner is not accepted. So remove the sales value. If you remove the 10,000 rupees, profit will go down by 10,000 rupees. And naturally, it will be subtracted from the purchases. If you subtract the purchases and expenses, as purchases value is decreasing, profit will be increasing to that extent. The ultimate neutralized value is nothing but 2000 minus. This is what about O. In case of P, this cash section 43A class 3 applicable only for the payment, not for the receipts, only for the payment. Here you are collecting the money from the debtors, though you collect the amount maybe more than 10,000 in the form of cash is now allowed, will be your income only. Hope you will be now able to understand. Right. This is only for the payment. So already we studied that the PGBP income can be shown under cash basis as well as mercantile basis. Whatever the method the assessee regularly follows will be accepted. We assume predominantly accrual basis, so we solve all the illustration using accrual basis only. If the assessee follows cash basis, what happens? For that, we'll move on to the last illustration. Very rarely this type of question also asked. Okay, cash basis. Usually this is applicable for the professionals. How can we calculate, sir? Mr. Sunil is practicing chartered accountant. He also runs a private coaching institute. Okay. His bank accounts for the year ended 31st March 2025 is given below. So balance sheet is means receipts and payments are there. Additional information: 20% motor car expenses is in respect of profession. Okay, motor car expenses. For that, 20% only related to the profession. Only 20% can be considered for deduction purpose. Balance 80% personal cannot be deductible. Depreciation allowable for motor car is 27,000 if wholly used for profession. Total depreciation. This is motor car purchase, capital expenditure cannot be deductible, but depreciation on this can be deductible under section 32. But as per section 38, what is that? If the asset not wholly used for the professional purpose or business purpose, only to the extent of usage for the business purpose will be deductible. So out of the total value, only 20% is used for the professional purpose. So business purpose. So you can deduct only 20% on 27,000 rupees. Hope you will be now able to understand. Outstanding fees of 31,325 2,000, whereas 500 received from Mita is considered bad. Now C point has no role because we are going to follow cash basis. Whatever the outstanding or advance, we never bother about it. On receipt, if you are receiving the fees in advance, also taxable. In the fees not received as outstanding, not taxable. What about the bad debts, sir? Only if you recover, you will consider this being the income. Bad debt means you didn't show this as your income and later on to deduct anything. So you no need to consider the bad debt. In case of credit transaction, what do? Debtors to sales. Okay, later on the amount not recovered, then automatically debited to the bad debt to debtors. But here we don't have the debtors concept. So the bad debt means already I have shown only the amount collected. If the amount not collected, I never bother about the bad debt. So it will not have any impact. Similarly, outstanding of fee. So this is also not required. Office expenses include payment rupees 2,000 incurred during the previous year. Also, no need to worry about that. Okay, previous year 23-24, sir, it was already spent in the previous year, sir. Related for this current year, can we deduct? So what usually we do? Office expenses paid. Add outstanding of the current year less advance of the current year, add advance of the previous year less advance of the current year. You have to do all these things. Outstanding of the, okay, outstanding of the previous year and advance of the current year. The ultimate value will be office expenses debited to the P&L account. This is item shown in the payment side of the receipts and payment account. I never bothered about this one. I bothered about only what? Payment. I have been given the payment, receipts and payment account only. Whatever the amount there, I can show directly. Motor car, okay. Audit fee. Audit fee is being the chartered accountant in receipts, audit fee, professional income. Income from other work, also professional income. Coaching fees, business income. Interest on investment, income from other sources. Examiners fees, income from other sources. Rent from house property, income from house property. You have to find out the income related to what head. What head? Is that clear? Now, office expenses related to his professional service, municipal tax paid, adjusted in income from house property, coaching expenses, business income, personal expenses not deductible, membership fees. To be a member in CA and CMA, CS, whatever it may be, they have to pay the fees. As he is doing the professional business, professionals, there will be revenue and from there it can be deductible. So professional, so being the professional, they have to pay the membership fees. So it's a part of their own professional expenses only, can be adjusted there. Life insurance premium, personal expenses, income tax cannot be deductible. Insurance of property cannot be deductible. Why? For income from house property, you can claim only one deduction, which is standard deduction at the rate of 30%. No other expenses related to the income is deductible. Now start with first one, PGBP income. PGBP income. First of all, professional. Okay, professional. For audit purpose. How much is the income? 2 lakhs. And income from other work, other professional work, 1 lakh. 3 lakhs. And expenses can be claimable. Office expenses, 18,000. And membership fee, 500. And motor car depreciation, out of 27,000, only 20%, 5,400 is deductible. And car expenses, out of 10,200, 20% only will be taken, 2,040. These are subject to section 38. These are subject to section 38. What about the total expenses? 25,940. If I subtract 25,940 from 3 lakhs, 2,74,000, 60 will be the value. 2,74,060 will be the value. Professional. Then we have the business also. In coaching, they get only 1,200 and 800 rupees expenses is there. PGBP. Not being the professional, it's what about the business. From 1,200, we assume that 800 rupees deductible as per the provisions of Income Tax Act. Balance 400 will be taxable. Okay. The overall PGBP income being 2,74,460. Apart from that, income from house property will be taken. Income from house property. So rent from property being 5,000 minus municipal tax paid 800, 4,200 being NAV. This 5,000 rent received will be GAV. Sir, what about the fair rent and others? Sir, if those things are not available, rent of the property will be considered as GAV. From that, municipal tax is subtracted. NAV minus standard deduction at the rate of 30%. How much is that? 1,260. Balance being 2,940. So here 2,940. 2,940. Apart from that, I had to go for income from other sources. Income from other sources. Under that, interest on investment, value being 2,000. Examiner's fee. Examiner's fee 1,000. No more items are there. Come on, add up all these things, will be called as gross total income. I think the value being 2,80,400. Are you getting this? From the gross total income, you can subtract deduction under section 80 series. Club being set off, if you are doing all these things, then you will get the taxable income. On that, you have to pay the tax. If the same chartered accountant working in anywhere as an employee, then automatically salary will also come. So salary you have to calculate as per salary topic provision. Rental house property, if he lets out for rental, that will also be calculated. PGBP calculated and income from other sources calculated. If there is capital gain, that should also be calculated. By adding up all these things, you will get the gross total income of the assessee. Hope now you will be able to understand. In most of the cases, small auditor, like if you are opening and running a show office, most of the clients will come with their only receipts and payment, bank statements. Sir, this bank statements are kindly file the returns of income. Okay, if you ask what's the total gross revenue you generated, he will not tell you. He doesn't know. If you ask you how much you spent for a restaurant in the previous year 24-25, will you be able to tell the answer? How much you spend revenue generated from your parents as a gift? Do you know? No. Similarly, for the street side vendor, a petty shop owner, does lots of buying and selling. If you ask him, what is the total sales revenue generated? Okay, only then I can file your return of income. The next moment, the client will say, I'll search the other good auditor. So they will come with the receipts and payment. Based on the receipts and payment given in the bank statement, you try to grab the taxable income for the tax purpose and pick those things and find out the gross total income. Sir, if he does all the transaction in cash, what happens, sir? Nicely escape, and all the money becomes black money. All the money becomes black money. Unless he says, how can I find out what is the real revenue generated? No, stuff. In Bangalore also it happened. No, they collected the sale price for the tea and snacks in roadside restaurant through GPay, UPay and all. Suddenly GST notice sent to all the small business owners. The next day they just simply removed that QR code and kept cash only. Now again, all those notices were waived and government is planning to give some excuses. Okay, if they are very stringent, then automatically what happens? Other mode is there. Okay, as the government's motto is to convert the cash mode to non-cash mode transactions, motivating that don't scare the customers currently, the assessors currently, for sometimes, at least for sometimes. Sometimes later, so what happens? No, probably 3 or 4 years later, you don't have the cash. Nowadays itself, we don't have the cash. Earlier, minimum 50,000 cash balance we will have for the immediate running expenses around 10 or 15 years ago. Now what happens? Whatever the cash requirement will transfer only from the account. Okay, cash flow is lesser. Hmm? You understand? So if all the things are digitalized, what happens? Cash will be running short. Printing 500 currency is going to be stopped. Maybe assume, may not be. Currently there is a stop. Sometimes later 500 rupees currency and 200 rupees currency also stop. You'll have only 100 rupees currency. If you want to give a bribe of 1 lakh rupees, how many pieces of 100 rupees currency you have to take? Just think over. One pack is around 10,000 rupees. You have to go with 10 packs. 10 packs in a suitcase, no, for 1 lakh rupees matter. You will be easily getting caught. In case of 2,000 rupees, it's a matter of how many notes? 50 notes. For 100 notes, you can give 1 lakh also. Now, there's a trouble. Cash is completely removed and digitalized. If it is digitalized, then all the things are available in receipts and payment. If it is given in receipts and payment, as you are being the auditor, you can easily pick and tell what's this revenue. You no need to pick and tell because AI is there to take care of those things. The AI can automatically pick all this detail and AI computes the taxable income and deducts the tax from your bank account. So getting ready for new job. Hope you will be now able to understand cash basis for professionals also. With that, all the calculations are over. Now we move on to the leftover 4 sections: 44 AD, AB, AD, ADA, and AE. Okay. Now we have completed 44 AA, compulsory maintenance of books of accounts. 44 AB, where the CA's role is important. Compulsory audit of books, which is called tax audit. Because of this reason only, CA remains topper. Okay, because of this reason only. Now the scope is going to be slowly reducing. CA. Compulsory audit of books of accounts, which is nothing but named as tax audit. Audit is done by chartered accountant and certified, signed by only chartered accountant. Right. Now, the compulsory audit required if your business total sales is more than 1 crore, definitely you can go for tax audit. Else, all of your receipts only in the form of account pay check, sir. I don't collect in cash. If you go for the big companies, all the transaction only in the form of account, not in the form of cash. If I'm collecting all my requirement only in the form of what? Account pay check or NEFT RTGS, not in the form of cash, then small amount I collect in cash, no problem. Very, very small amount. Maybe overall collections in that 5% only, less than or equal to 5% only in the form of cash. Then audit not required if total sales is less than or equal to 10 crores. Up to 10 crores, you no need to get your books of accounts auditor. You no need to get the service of auditor at all. You can do it yourself, provided all the receipts should not be in the form of cash. It should be in the form of account paycheck. Only a 5% can be in the form of cash. No, sir, I have the cash form almost 30 or 40%. Then only 1 crore is limit. 1 crore is the limit. So business, usually if the total sales is more than 1 crore, compulsory audit is there where auditor should verify and sign as per section 44 AB's requirement. And if your business total sales is more than 10 crores, provided aggregate cash receipt is less than or equal to 5% of the total receipts. As well as aggregate payment also less than or equal to 5% of the total payment. Then automatically you will be excused to get your books of accounts audited up to 10 crores. Okay. Now, this cash payment includes bearer and cross check also. Whenever it's a cross check and bearer check, all the three together will be considered as cash only. 2 points. Okay. Sir, what happens in case of professionals, sir? Doctors, engineers, advocates. Okay, already we have studied that, right? These are the set of professionals. In those cases, based on the gross receipts will be taken. If the gross receipt is more than 50 lakhs, then they have to get their books of accounts audited compulsorily. Doctors. For doctors and advocates, there is no any expenses. Only clinic. If Mr. Dr. X has a clinic, the major payment for the clinic is rent, EB, and staff, probably nurse. And then that too very small amount. Whatever the fee they collect will be their income only. So 50 lakhs is the limit. Okay. If you go to the dentist, the fee may be around 4,000 or 5,000. The salary payable to the nurse may be around 8,000 rupees per month. And the rent may be another 10, or EB, everything put together 25,000 rupees. But they charge around 4,000 or 5,000 rupees per patient. Around 100 patient means it already crossed 40 lakhs. Okay. Almost 100 patient means 4,000 into 100, 4 lakhs. 4 lakhs plus. Am I right? So out of 4 lakhs per month, 25,000 expenses means almost 3.5 lakhs and above will be your income. Right. So in that case, you have to get your books of accounts audited, being the professionals. Now, in case my income is not 1 crore, sir, 1.5 crores, do I want to get my books of accounts audited, sir? Yes. Don't I get some excuse, sir? Okay, I'll give some options for you. From 1 crore, rather than 1 crore, make it 2 crores also. Up to that period, you no need to get your books of accounts audited. Union no need to maintain the complete books of accounts in detail. Okay, for what? If you add 44 AD, ADA and AE, these three sections are applicable at inter level. And 44 BB and 44 BBA, if you add, this will be applicable for final level. Okay, for that, of course, section 44 AB, tax audit not required. Tax audit not required. What about 44 AD? Whatever the gross receipts you collect, on that 8% or 6% will be your income. No need to calculate for each and every items to be deductible. Already we have seen, right? This is called presumptive taxation. These are the 5 sections are for presumptive. We assume this much will be your income. How much? What are the gross receipts now? In that 8% will be your income. If all the receipts are being in the form of account, means through bank, then only 6% is your income. No need to consider for claiming the depreciation expenses, administration, office, furniture expenses, and the salary. Don't claim all these things independently. In the total income, only 8% is your income. I don't want to ask you further. Okay, so my income is 150 lakhs. How much will be my presumptive income, sir? Presumptive income. Under section 44 AD, I assume it may be in the form of cash. Then 8% will be taken. So 8% of this being 12 lakhs. You have to pay the tax on only on 12 lakhs. But if you say, sir, not 12 lakhs, sir, 150 lakhs, I did the sales, but my revenue is not 12 lakhs, sir. My revenue is only 4 lakhs, sir. So if you don't want to go for that, automatically what happens? No, you have to maintain your books of accounts as per section 44 AA. After that, show the books of accounts to the auditor and get it audited and certification also from auditor as per tax audit. Then this 4 lakhs is acceptable. Blindly on your total receipts, 8% will be your income. For that, you pay the tax. Or blindly just calculate 6% and pay the tax. So if you feel that even 8 or 4 6% is not really possible, your income is still lower, then maintain the books of accounts systematically and get it audit if the value is more than 1 crore. More than 1 crore. If you want to show income less than the income presumptively stated under section 44 AD as well as ADA AE, then of course you can maintain the books of accounts and get it audited. So 44 AB applies when declaring lower income. 44 AB applies when declaring lower income by not availing the provisions under this section. These sections gives you a rough estimation for the profit based on some value, 8%, 6%, 50% like. Okay. If you say, no, sir, my income is still lesser, then you have to maintain the books of accounts as per section 44 AA, get it audited under section 44 AB. Fourth, due date for audit is 1 month before the due date for filing of return of income. So 1/4/2024 and financial year ends on 31st March 2025. What is the due date for filing of return of income as per section 139 class 1 for the audit case? 31st October 2025. Am I right? This is what about the due date. Requires no audit means 31st July. Requires audit means 31st October. If 31st October will be the due date for filing of the return of income, at least 1 month earlier you have to finish up your auditing. Means 30/9/2025. Within this period, you have to complete the audit. Due date for completing audit 1 month before the due date of filing of return of income. And if you fail so, then penalty will be applicable under section 271B. 271A is the penalty for non-maintenance of the books of accounts, and 271B is for non-getting your books of accounts audited. Okay, where 5%, 0.5% of turnover or 1.5 lakhs, whichever is lower will be your penalty. These are the 6 points you have to understand. Under section 44AB, compulsory audit, that will be named as tax audit. In case of business, okay, where the total sales exceeds 1 crore, you have to get your books of accounts audited. To get your books of accounts audited means you need to maintain the books of account in systematic manner ahead of that. So under section 44AA. Second, though your turnover is more than 1 crore, yet you collect all the money only in the form of account, and payment is also in the form of account. There may be small amount, maybe in the form of cash receipts and payment, which is less than or equal to 5% of the gross receipts as well as payment. Then requires no audit up to 10 crores. Up to 10 crores. And in case of professional, 50 lakhs is the limit. In case of professional, 50 lakhs is the limit. And in case of section 44 AD, ADA and AE, there is one more limit. To that extent of limit, you no need to get your books of accounts audited, provided if you want to show lesser income, then you have to get the books of accounts audited after maintaining the books of accounts under section 44 AE. Clear? You have been given this option, but you neglect this option, then you have to go for 44 AA and 44 AB. And due date for audit is nothing but 1 month earlier than the due date for filing of the return of income. If you fail so, then you have to pay the penalty under section 271B. 0.5% of the turnover or gross receipts or 1.5 lakhs, whichever is lower, you have to pay the tax. Okay, penalty you have to pay. Let's start with 44 AD. Presumptive taxation scheme for business. This is optional. From this, it is very easy to understand. It's optional. If you don't go for this one, automatically what you have to do? You have to go for section 44 AA provisions to be followed to maintain the books of accounts. As well as you have to maintain, you have to get your books of accounts audited under section 44 AB. So, do you want to go for 44 AD or this one? That's your choice. That's your choice. Is that clear? Now, this 44 AD is not applicable for all, some selected people only. So, I am going to cover those things here now, right? This one is eligible for resident individual, resident half, resident firm excluding LLP, not applicable for LLP. Only for this individual half firm. That too, they should not enjoy the benefits under these sections. Okay. 10 AA or 80 IA to 80 RRB. Okay. This is related to the export benefits. This is related to some other benefits like recruitment of additional employees and royalty and all. Okay, those benefits you cannot enjoy. If you don't enjoy this one, okay, then automatically you can enjoy this benefit. Section 44 AD. Resident individual, resident half, resident firm, not for the non-resident. And applicable business, what sort of business you can do? Any trading activity business. Exclusion. Okay. It should not be for, okay, agency business, commission business, brokerage business. Agency, commission and brokerage. Even though 44 AE should not applicable. 44 AE is for the transport vehicles. Transport business. Okay. Goods carriages. For the goods carriages, agency business, commission business and brokerage business if you are involving. For in case of house brokers. Okay. What happens? Their expense is zero. They just get the tenant and owner connected and get the commission. There is no any expenses. So, because of that reason, this 44 AD will not be applicable. Because if you give these provisions for the brokers, what happens? For selling 1 crore rupees worth asset, they will get around 2% or 4% commission, 4 lakhs. They will say only 8% is my income. Will it be true? Definitely, it's not possible, right? Their expense is very, very lesser. So, they have to maintain complete set of books and get it audited. So, for them, that 44 AD will not be applicable. and turnover limit. This will be applicable where the turnover is less than or equal to 2 crores. So if I add to 4480, if I add 4480, I don't want to go for what? 44 AB. I don't want to go for 44 AB. You know that compulsory audit required if the gross sales is more than 1 crore. More than 1 crore gross sales, then automatically audit is must. But if you choose 4480, you escape from 4480. And in your overall receipts, less than or equal to 5% only cash, then the limit is increased to 3 crores. Then the limit increases to 3 crores. Clear? Less than equal to 2 crores turnover limit, of course you can enjoy the 4480 scheme. Less than or equal to 3 crore scheme, of course you can enjoy the same 4480 scheme, provided your cash collection should be less than or equal to only 5% of the total turnover. And key provisions. What about the deduction under section 30 to 38? Assumed already allowed. Means your receipts being, gross receipts being around 100 lakhs. Then what about your presumptive income? In case if it is being only in the account form, not in the form of cash, then 6% will be considered. 6% being only 6 lakhs. Can I claim the deduction under section 30 to 38? Sir, no, sir. The 94 lakhs already deducted, is assumed to be these sections deductions. You cannot claim further. You cannot claim further. Not separately claimable. If you show only 6% as your income, remaining 94% is assumed to be the other incomes, other expenses. You no need to further claim. One more, sir, I paid rent 1.5 lakhs. Can I deduct? No, sir. That also included in 94 lakhs itself. And in case if it is being cash, rather than 6%, it may be 8%. And what about the partner's remuneration? Can I claim section 40 clause B salary in this, sir? No, not allowed. Depreciation, sir? Not allowed. Though depreciation is not allowed, next year, for example, the opening WDV in this block is say 100 lakhs. Depreciation, here I have not claimed the depreciation separately, yet you have to subtract 15 lakhs and 85 lakhs is the closing WDV. Why, sir, I want to do this one? You have to do this one. In the next year, you're supposed to go for regular tax audit and pay the tax as per the tax audit. In that case, depreciation for the next year claimable only 15% on this 85 lakhs, not this one. So WDV gets adjusted, but the depreciation cannot be claimed further. Okay, depreciation cannot be claimable additionally. These are the 3 points. You cannot claim any deductions under section 30 to 38 from this PGBP. Second, you cannot claim any remuneration as per section 40 clause B to the partners. Third, depreciation also be not deductible, provided WDV is adjusted after the depreciation only. Okay. And exemptions. You no need to maintain the books of account for audit, or you no need to maintain the books of account. So 44 AA is not applicable. And 44 AD is also not applicable. Clear? These two are not required. And what about the advance tax payments, sir? 100% in one installment by March 15 itself. 100% in one installment by March 15 itself, you have to make the payment. That advance tax and other things we'll study later on. At what point in time you have to pay the tax. So that will be studied later on. By the time you'll recap this one easily. Right. Here you need to understand advance tax 100% will be payable by 15th of March itself. 1/4/24 to 31st March 26. 24 to 25. In that 15th March 25 itself you have to finish up paying this. Before end of the financial year itself. Before end of the previous year itself. So how can I guess that, sir? You can guess the estimated value and calculate completely. You pay the value immediately. Now, sir, can I opt out this class, sir? 44 AD is a choice. Do you want this one or this one? 44 AA and 44 AB. What model do you want to follow, sir? This one or this one? You have eligible, okay, 44 AD. Eligible but you are not apted. You are eligible for 44AD, but you are not apted 44AD. You apted this one. Once, though you have the options to enjoy 44AD benefit, but you don't enjoy and shifted to 44AA and 44AB, thereafter, in the next year, this is the current year, the next year, you will be eligible under section this one 44AD, yet you cannot add this one. You are not allowed to take. You have to go for this one only. For how many years? At least for 5 years. The year in which you are eligible for 44AD, but you neglected to take this and you go for getting into your books of accounts audited, then thereafter you are not eligible for 44AD for at least 5 more years. So, if not declaring income under 44AD in any year, yet you are eligible, barred from apting 44AD for 5 subsequent years. You are eligible for 44AD, but you apted for 44AA and AB. Then leaving that year, thereafter 5 years, though you can enjoy 44AD, but 44AD is not allowed. Is that okay? Now, as per 44AD, for 100 lakhs, your PGBP is 6 lakhs only as per 44AD. But you say, sir, no, sir. For 100 lakhs, I actually faced 15 lakhs loss, sir. What can I do? If you want to show lower than the profit stated under section 44AD, it means you have to shift yourself out from 44AD to 44AA and AB. These two are in clubbed. Unless you maintain the books of account, how it gets audited. So you have to get maintain the books of account and get it audited. Hope you will be now able to understand section 44AD. Now see here. See here. Let us consider the following particulars. Let us consider the following particulars. Okay. Relating to resident individual Mr. A being eligible assessee carrying on retail trade business, whose total turnover do not exceed 2 crores. So it means he is naturally falls under section 44AD eligibility. Okay. Now, in the previous year 25-26, total turnover 1 crore 80 lakhs, amount received through prescribed electronic mode on or before this date being 1 crore 60 lakhs. So what happens here? Total turnover this much, 1 crore 60 lakhs through account form, balance being cash form. Balance being cash form. How much? 20 lakhs being in cash form. Right. He has the options to go for 44AD. Eligible. Eligible means we have to calculate 6% on this, 8% on this. For the account form collection, you have to consider only 6% as your income. In case if you collect that in the form of cash, cross check, 8% will be considered as your income. Come on, calculate that value. I think 11 lakhs 20,000 rupees. This is your income. So what happens? Eligible. He has apted the 44AD. Offered income as per the present taxation. No problem. No problem. So in the assessment year 25-26, his gross total income is less than 2 crores. Less than 2 crores means he is eligible for section 44AD. If he is eligible for 44AD, next whether he has apted or not. Apted means he has to pay the tax based on the income calculated presumptively. 6% on account collection, 8% on cash collection will be his present income. For that he has to pay the tax. For the assessment year 26-27, total 1,90,000, 145 is in the form of account. Balance how much? Another 45 lakhs in the form of cash. Then for this 6% will be taken, for this 8% will be taken. So they have calculated the same way. 6% on 1.45 lakhs, 8% on 0.45 lakhs, sorry 45 lakhs. This value is 12 lakhs 30. Is he eligible under section 44AD? Yes, sir. Has he chosen that one? Yes, sir. So he is eligible and he has chosen 4480. No problem. For the assessment years 27-28, total turnover 2 crores. Up to 2 crores or less than 2 crores eligible for section 4480. 1 crore 80 lakhs being account pay check moolam, account pay check. Another 20,000 being cash. On that 6%, on this 8% can be taken. Is he eligible? Of course, sir, he is eligible. Now the question is, has he apted? No, sir, he has paid only 5% under total turnover 10 lakhs. Means he has not apted 4480. 4480 not apted means he might have followed which method? Maintaining the books of accounts as per the requirement specified under section 44AA and his books of accounts getting audited under section 44AB. Clear? 44AB. Clear? So in the year 27-28, he is eligible but not apted. But not apted. When? Okay. Assessment year 27-28. In this case, thereafter 28-29, 29-30, 30-31, 31-32, 32-33. In these 5 years, he is not eligible for taking 4480. He is not having the choice to take 4480. Though he has eligibility if he gets his books of accounts audited and paid the tax lesser than the presumptive basis taxation, hereafter he is not eligible for 4480. He is not eligible for 4480. Clear? For how many years? 5 years. Thereafter, of course, he can enjoy. Again, thereafter also his gross income is less than 2 crores. Of course, he can choose 4480. Up to 5 years, debought. Here. Okay. Apting out disqualifies benefit for the subsequent 5 years. This much year, he is not eligible for this. Clear? Clear? Hope now you'll be able to understand this provision. Shall I move on to the next one? So 4480 is now clear. AA over, AB over, AD is also over. Now we'll move on to the ADA. 2 more sections, ADA and AE. With that, entire PGBP topic is over. Right. Mr. Praveen engaged in retail trade. Reports turnover 1 crore 98 lakhs 50,000 for financial year 24-25. His total income from said business as per books of accounts being 13 lakhs 20,000 rupees. This is nothing but as per his books of account. He maintained the books of account and he realized that his income is only 13 lakhs 20,000 rupees. Okay. Retail trade is the only source of income for Mr. Praveen. Assessment year 24-25 was the first year for which he declared his business income in accordance with the provisions of present income under section 4480. Earlier year also, he followed only 4480, no problem. Mr. Praveen is also eligible to add for present determination of his income chargeable tax for the year. Okay. Okay. Can he add present determination of income? Yes. As his turnover is less than or equivalent to 2 crores. He is eligible for 4480. Present determination of income falls under 4480. Of course, he is eligible. If so, determine his total income from retail trade as per the applicable present provisions. In case of present income, 1 crore 98 lakhs 50,000 rupees. On that, I assume everything is collected in the form of cash, means 8% will be the present income. What is that? 15 lakhs 88,000. For third question, in case Mr. Praveen does not act for present taxation of income from retail trade, what are his obligations? So as per the books of account, his income is only 13 lakhs 20,000 rupees. Present income says you have to pay the tax on 15 lakhs 88,000. He says, sir, no sir, my income is only 13 lakhs 20. Will he be able to go for showing this as his income rather than this one? Yes. If he wants to go for showing this as income, he has to fulfill two conditions. That number one is he has to maintain the books of account as per the requirement specified under section 44 AA, rule 6F we have seen. Apart from that, he has to get it books of accounts audited as per the provisions under section 44 AB. No other way. Clear? Hope now you'll be able to understand 1, 2, 3. Three cases over. Then fourth case, what is the due date for filing of his return of income under both the options? Due date. In this case, the due date being 31st July requires no audit, right? In case he acts out of that 44 AD, he doesn't want to go for that, then he has to get it books of accounts audited, then 31st October 2025 will be taken. Okay, clear? Hope now you'll be able to understand. So I think this question carries around 6 marks like in your examination. Questions are very simple. There will not be any complications. But by hearting the provisions is most important. Now, we'll move on to the next one. We'll move on to the next one. In case of 44 ADA, this is applicable for professionals. Already we referred who are called professionals. Also, the provision similar to what? AD only. You no need to study further. Only one point, it is for professionals and gross receipt should be less than or equal to 50 lakhs rather than 2 crores and 3 crores here, 50 lakhs and 75 lakhs. And income 8% or 6%, you know, here it is 50%. Rest of the things are similar. Professionals, the turnover date 2 crores or 3 crores restricted to here 50 lakhs or 75 lakhs. Third, the income will be considered as 8% or 6%. Here it is not so 8 or 6, it's only 50%. Rest of the things are same, ditto. 44 ADA is similar to 44 AD. Let's now move on to the last section here for the PGPP topic, 44 AE. In case of 44 AE, this will be applicable for the transporters owning goods carriages business. The overall goods carriages they have in a year in any point in time should not go beyond 10 vehicles. Should be less than or equal to 10 vehicles only, goods carriages. Lorry and mini lorry, whatever it may be, pickup truck. Provided, in case of heavy goods vehicle, 1000 rupees per ton per month will be taken and part thereof. One day, if you use if you hold the means lorry for a day, you have to consider 1000 rupees per ton as your revenue. This is your revenue. You have heavy goods vehicle. Its weight is more than 12 ton, then it is heavy goods vehicle. Less than or equal to 12 tons will be considered as other vehicles or light goods vehicle. Okay, these two put together, maximum how many numbers you can have? 10 numbers in any of the days in the previous year. Buy and sell. You purchased, you sold 5 items, purchased 5 items, no problem. But you purchased, you sold 4 items and purchased 5 items. The next day you sold 1 item. Automatically what happens? While selling 4, it becomes 6. While purchasing 5, it becomes 11. The next day you sold 2 items, then 9. But that one day you have 11 items, no, 11 vehicles. Then you lose section 44 AE benefit. If you lose section 44 AE, what happens? Go and maintain the books of accounts as per section 44 AA and get your books of accounts audited in section 44 AB. Clear? And in this case, 7,500 will be your presentive income. Your presentive income being 7,500 per month into number of vehicles. If the goods carriage is having 12 tons and above, more than 12 tons, 1,000 rupees per ton into number of tons, the weight. But this is what about the income per month. Income per month. Even one day will be considered as 1 month. Okay. If you have a lorry 15 ton capacity, okay, weight, okay, 15 tons, then what happens? 1,000 into 15, you have to multiply with this one. For how many months you have? 4 months, 1 day. Then you have to multiply with 5 months. This will be your percentage income. What about the deductions with respect to the income expenses between section 30 to 38, sir? Everything is deducted. Okay, already we calculated the same way, no? The same applicable. One difference is there. What's that? 40B is allowed. Remuneration to the partner is allowed. From this income, you can reduce the remuneration payable to the partners. In case of 44 AD, ADA, in those two cases, whatever the rate you apply on your gross receipt, 8%, 6% or 50% will be the ultimate taxable income, and that you have to pay the tax. In case 44 AE, you can calculate based on the numbers we have listed here. From there, only one item can be deductible, which is nothing but salary to the partners as per section 40 class B. You can subtract. So earlier it is not allowed. Okay, 40B, no deduction. But here it is allowed. Only this point is different. The rest will be the same. Okay, depreciation as per the earlier one. Okay, as per the earlier one, not allowed. Deductions not allowed. And if you have the mixed business, transport or regular business, what you can do, sir? For transport, section 44A is applicable. For the regular business, you can do other methods of calculation. Probably, if you are involving in trading activity, you can go for 44 AD. Or the turnover in this business is more than 3 crores or 4 crores, then you can go for regular audit of this one. For this 44A is applicable separately. 44A is applicable separately. So if you want to show the profit less than this, will it be possible, sir? Yes, of course, you can go for section 44 AB after maintaining the books of account under section 44 AA. Only this number is very important. Rest will be the easy one. Right. Let's try to solve this illustration. Now, Mr. X commenced the business of operating goods vehicle on 1/4/24. He purchased the following vehicles during the previous year 24/25. Complete the month. Okay, this one purchased in which month? 10/4/24. How many vehicles he has in the year? Come on, add up that. 6, 7, 8, 9, 10. Maximum 10, so he is eligible for section 44 AE. This one purchased in April and used throughout the year. Gross vehicle weight being 7,000 up to 12,000 kilogram. 12,000 kilograms or 12 ton, it will be considered as what? Light vehicle. So light vehicle, okay, light vehicle, and heavy vehicle, heavy goods carriage, heavy goods vehicle. Clear? In case of light vehicle, 7,500 rupees per month. How many number of vehicles we have? 2 numbers. Date of purchase being 10/4. So means 11 months and part of the month will be converted into 12 months. What about the present income here? 1,80,000. What about this case? 7,500, number of vehicle being 1. When it was purchased 15th March, only 16 days used, 16 or 17 days used, then it will be rounded up to the 1 full month. So the value being 7,500. and this one 7,500, number of vehicles being 3, and 16,7 means 9 months, including the July month, 9 months, the value being 2 lakhs 2,500, and in this case 7,500 into one vehicle for how many months? February and March, 2 months, right? So into, oh, January, no, January, February, March, 3 months will be taken, so the value being 22,500. And heavy goods vehicle 15 tons multiplied with 1,000 per ton multiplied with the number of vehicles 2 and purchased in August. So including August you have to calculate how many months are there? 8 months. Okay, 8 months. Then the value being 2 lakhs 40,000, and the last one being 15.4 ton. 15.4 ton per ton 1,000 rupees. One vehicle, how many months? Purchased in February, March, 2 months. Come on, find out the value here. 30,800. So present income in this case being 6,83,300. If you have section 40 class B eligibility, you can claim salary deductions. Anyhow, X comments. It's not partnership firm. This will not be applicable. So this is the present income. He has to pay the tax on this. He may say that, sir, I didn't drive the vehicle entire year, sir. Lockdown, I kept idly, sir. Then what can we do? Naturally, you have to pay the tax as per this rules only. But else you have to go and maintain the books of accounts, get it audited. Pay the lesser tax. Also applicable. Clear? So 44 AE provisions also over. Let's move on to the comprehensive illustration. Practical question number 1. Okay. That's only illustration left over to be solved. So once it is over, the entire PG will be over. So we have completed all the provisions. If it is clear, text me. So we'll move on to the last illustration. Now, Mr. Sukhvinder engaged in the business of flying goods carriages. On 1st April 24, he owns 10 trucks. Out of which 6 are heavy goods vehicle. Heavy goods vehicle. Unladen weight being 15 tons. On 2nd May 24, he sold one of the heavy goods vehicle to 524. He sold one of the heavy goods vehicle and purchased a light goods vehicle on 6th May. So light goods vehicle being 4 existing. Out of that, one more purchased in 6th May 24. This new vehicle could not, however, be put to use only on 15th June. Put to use is not going to be taken here. The put to use concept is applicable only for the depreciation here. Whether you use it or not, you have to pay the tax based on this number. Compute the total income of Mr. Sukhvinder for the assessment year 25-26. We first calculate the presumptive taxation under section 44AE. Okay, presumptive income for the heavy goods vehicle. Out of 6, 1 is sold, 5 remains with us for the entire year. We will finish up that 5 first of all. 5 into 15 tons into 1,000 rupees per ton into entire 12 months. Come on, tell me the value. 9 lakhs. Another one having 1510 value rupees 1000 held up to 2nd May, April, May, only 2 months, 1 month and 2 days. So convert that to full month, 2 months. Come on, find out the value here. 30,000 rupees. Now, light goods vehicle. In case of light goods vehicle, 4 remains with them for the entire year. In case of light goods vehicle, we never refer to the weight, only 7,500 flat rate will be taken. 4 into 7,500 into 12 months. How much is that? 3 lakh 60. And apart from that, one new asset also purchased, also light goods vehicle, 7,500. The date of purchase being 6/5. 6/5 to the 31st March, maybe 11 months. Am I right? Okay. This month may be part of the month will be considered as one full month. So overall 11 months, 82,500. The overall revenue from the owning and maintaining the goods carriages being 13,72,500. We'll cross check here. Freight charges collected 8,70,000, depreciation 1,85,000, other expenses this one. Your net profit being 45,000. Now come on, tell me. Do you want to pay the tax on 45,000 or 13,72,500? Apart from that, other business and non-business income is also there. It's a separate one. Now the question is, would you like to pay the tax on 13,72,500 or 42,500? Paying tax on 13,72,500 is very costly. 30% of this means more than 3 lakhs something, 4 lakhs, closer to 4 lakhs. But if you want to pay the tax on 45,000 rupees, it will be very small amount. Sir, can I add this one, sir, rather than this one, sir? Yeah, of course you can go, but you have to maintain the books of accounts as per section 44AA and 44AD. If you follow that, your gross total income being 1,15,000. If you follow 44AE, AE business and other business income, 70,000 should be addable. So you have to pay the tax on 14,42,500. Now it is your decision to go for either this one or this one. Do you want to add 44AE or do you want to maintain the books of accounts and get it audited to show lesser income and pay the lesser tax? It's up to your choice. Okay. So in book I have given this option as well as this option. Option is given. Now decision is the assessor's one. Usually you will go for this one. Okay. You can recommend to get the books of accounts audited. So with that, the PG